Hello, good evening, and welcome to Unacademy IAS, a one-stop destination for all the English medium civil services aspirants. This is Sham Kagod here, taking up a marathon session on the concept of banking today. Those who are present in the session, please do let me know that I'm audible and visible for all of you. Those who are present, give me the confirmation, please. Those who are present, done. Thanks a lot. Let's start the session then. So today this will be a marathon session where I'll start with the basic concepts of banking and we'll keep on building with advanced concepts. And every now and then we will also discuss important MCQs. Let's do the complete chapter of banking in today's session. And this session will be lengthy. Be ready for it. Now, before I start the session, a very important announcement. Those who are appearing for the Civil Services 26 and 27, right now, our courses are available at a discounted price of 50%. And not just that, you'll also get dual validity, wherein if you purchase the course for 12 months, we're going to give you additional 12 months free of cost. And if in any case, if you are not able to clear the exams and you are enrolled into our courses, then your next attempt will be on us. Just check the details by clicking on the link provided below. And if the discount is not available in the website, use the code IAS English. And I've been told that tomorrow will be the last day of this particular offer. Let me begin the discussion now. Starting with, since we are discussing the concept of banking, starting with the basic definition of a bank. Now, a lot of you will know what is a bank. You will simply say, sir, bank. If I ask you, please define bank. You will simply say, sir, bank is bank. I go to bank. I keep money in bank. You will start giving me examples of SBI, Punjab National Bank, Canara Bank, etc., etc. But is there any provision under any law which defines a bank? Please remember, can be asked suddenly as a surprise to you in the exam. There is a particular section in the Banking Regulation Act. Banking Regulation Act. Banking Regulation Act of 1949. The Banking Regulation Act of 1949, specifically Section 5(1)(b), states that a bank is an institution which is involved in collection of deposits. And what is the use of the deposits? The deposits will be used to give loans. The deposits collected will be used to provide loans. And if the customer wants to withdraw money, they can withdraw the money at any point of time, either by literally going to the bank, writing a check, etc. So this is the definition which has been provided under the Banking Regulation Act. Please remember, the section number can be asked in the exams. Now, whenever you talk about the bank, please understand the banks, like I said, are involved in collection of deposits and are involved in giving of loans. Now, there are two terminologies in the context of the bank that you need to remember. One is the assets of the bank and the second one is the liabilities of a bank. And already one question in the prelims couple of years ago was asked by UPSC associated with this. That is, what is the asset and what is the liability concept? Imagine here is a bank. The bank will collect deposits and the bank will use these particular deposits to give loans. Now, on the deposits that are collected by the bank will pay interest. Is everybody okay with this particular point? The bank will pay interest. And on the loans which are given by the bank will earn interest. The bank will earn interest. So the deposits which are collected by the bank, these are basically the money which the bank has to return back. The bank has to give back. Hence, these deposits are nothing but liabilities. The deposits are liabilities. Is everybody okay? And on the other side, the loans which are given by the bank are generating interest, are generating revenue for the bank. Hence, these loans which are given, the investments that are done in government securities, etc., these are called as assets for the bank. The assets for the bank. Now, why should understand all of this? The liabilities are further divided into two types. This is purely UPSC territory now. The liabilities are further divided into two types. One is called as a time liability and the second one is called as a demand liability. Right? Time liability and the demand liability. The demand liabilities essentially refers to those deposits which the bank has to return whenever there is a demand from the side of the customer. Whenever there is a demand from the customer or the depositor. For example, I'm pretty sure most of you, if not all of you, most of you have got savings bank accounts. It could be in SBI, it could be in Punjab National Bank, it could be in ICICI, doesn't matter. You have the savings bank account. Now, when you go to the bank, you want to withdraw the money from the bank. The bank has to allow you to withdraw the money. The bank has to give the money to you. Provided, I hope you understand, provided there is money in your bank account. You cannot simply go tomorrow to the bank and simply say, yesterday Sham sir told me in the class, right, I've got bank account, I want to withdraw 1 crore rupees. But there is no money in your account. You have minimum balance. Right? So you can't go to the bank and simply say that. No. And moreover, if you go to SBI, they'll simply say lunchtime, come back after 1 hour. So I hope you understand the money that is there in these kind of accounts. It could be salary account. It could be the savings bank account. It could be the current account. This money can be withdrawn upon demand of the depositor. These are referred to as demand, right? Let's say deposits or demand liabilities. Is everybody okay? And on the other hand, there are also time liabilities, right? What are these time liabilities? These are the kind of deposits which are kept with the bank for a specific time period. These are kept with the bank for a specific time period. What do you mean by specific time period? Let's say fixed deposit. You will keep the fixed deposit for a duration of 3 years or 555 days, 444 days or 10 years for that matter, etc. That is basically the time deposits. So time deposits are the deposits collected for a specific time period, but these are returned. Along with the interest, these are given back, hence called as time deposits or time liabilities. And the other side, there are demand liabilities as well. Now, there's a technical term, please remember, when you take the sum total of both of them, these will provide you the gross demand and time liabilities. The gross demand and time liabilities. This technically is referred to as GDTL, gross demand and time liabilities. From the gross demand and time liabilities, you subtract certain types of deposits. For example, interbank deposits. I repeat, from the gross demand and time liabilities, you subtract certain types of deposits, that is interbank deposits, and that will give you the net demand and time liabilities. NDTL, the net demand and time liabilities. Is everybody able to understand? So far the concepts are clear. Please do let me know in the chat section. And before I go forward, whenever I take the live session, I want the session to be interactive. I don't want it to be monotonous. I want it to be interactive. If I ask you a question, please reply. Correct, incorrect, doesn't matter. It's a learning process. But if you simply keep quiet, after 5 minutes, your pen will be on the paper. You'll start feeling sleepy and you will sleep off. And you will definitely wake up when I say, let's take a dinner break. Right? So please keep on interacting with me. If there's a doubt, please do let me know. Okay. Now within this particular concept, I want you to remember one more idea. That is bulk deposit. Bulk deposit. This was there in the newspaper a couple of months ago. Bulk deposit. What is this idea of a bulk deposit? Whenever the banks are collecting huge value, higher value of a deposit, that is a fixed deposit, or these kinds of deposits, these are called as bulk deposits. In the context of the scheduled commercial banks, normal banks, if you're collecting anything over 3 crore rupees, RBI defines this as a bulk deposit. But in the context of, let's say, the local area banks, in those kind of banks, if anything is collected up to, above 1 crore, 1 or above 1 crore, that is called as bulk deposit. This can be asked in the prelims. It was there in the newspapers. Why? I'll give you a simple idea. In the recent times, there has been a structural shift that has been observed. I repeat, structural shift. What is this idea of a structural shift? Structural shift is lot of these depositors which were traditionally keeping the money with the bank have started taking the money out of the bank and have started investing in the stock market. They have started investing in the mutual funds. They have started investing in SIPs. And I'm pretty sure some of you have already done this. So when these particular deposits have been taken out of the bank, this is not a temporary change in the pattern. This is not a temporary change in the behavior of the depositors. No, this is a structural shift. And this is not going to change anytime soon. So the Reserve Bank of India as well as the banking sector, they were discussing, should we start running behind bulk deposits now? And the finance minister said, no. Don't go behind bulk deposits. Go behind larger number of small depositors. Larger number of small depositors. Collect more and more from small depositors. Reason being, today you might collect a bulk deposit, let's say 10 crore rupees. But tomorrow, if the customer withdraws, one customer, if they withdraw the complete bulk deposit, suddenly there will be impact on the balance sheet of the bank. So finance minister reprimanded the banks and said, don't run behind bulk deposits. Go back to the traditional idea of a banking. Collect as much as possible, a large number of small deposits. Done? Everybody is okay? Those are asking, sir, what is the gross demand and time liability? The deposits which are collected by the banks can be divided into two types. One is time deposit. They will be kept with the bank for specific time period. Best example, fixed deposit. Recurring deposits. These are called as time deposits. But these are liabilities because the bank will return it back. And the second one is the demand deposits. Best example, the savings bank accounts that you have kept with the bank but will be returned by the bank. That's a liability. So sum total of both of them is called as gross demand and time liabilities. Done. Can we go forward now? Now let me see how many of you are listening to the session. How many of you are understanding the concepts? Here is the MCQ. Please solve the MCQ and tell me the answer quickly. And this is not a very difficult question, by the way. If you have understood the concept so far, very easy question. Which of the following are part of liabilities of the bank? Liabilities of the bank. Fixed deposits, savings bank account balances, salary account balances, housing loans, loans for companies. Liabilities. Liabilities obviously means the deposits collected by the bank. What is the answer given by most of you? Okay, B. Let's start. Fixed deposits. Is it a liability? Yes. Savings bank account balances? Yes. Right. The salary account balances? Yes. Right. So first, second and third, loans, right, either given for individual or given for a company. Doesn't matter. Loans are basically assets. Loans are assets. Some of you are making mistake. Someone, my dear user, someone, not option A. 1, 2 and 3 are correct. Right option for the question will be option B. Option B. Loans are assets for the bank. Right? The deposits are liabilities, my dear, for the bank. I'm not asking you. I'm not asking for a customer. I'm asking for the bank. Right? So for the bank, loans will get returns, assets. The deposits have to be returned back, have to be given back. That will be the liability. Okay. Interbank deposits essentially means one bank keeping deposits with another bank. It is allowed. For example, when I discuss payment bank, I'll discuss that. Don't worry. Okay. One more easier question. Please solve it and tell me the answer very quickly. How many of the following are examples of demand deposits in the banking sector? Current account, savings bank account, salary account, fixed deposit and recurring deposit. Please don't make a mistake here as well. Please don't make a mistake here as well. These kind of questions are full toss. If you're a cricket fan, these are full toss balls. You will have to hit a 6. Don't become hit out. Okay. How many of the following are examples of demand deposits? Which means you can withdraw whenever you want to withdraw the money. The bank will allow you to do that. Current account, can you withdraw at any point of time? Of course, yes. Savings bank account, yes, you can withdraw the money at any point of time. Salary account, yes, right? It's basically a savings bank account only. And somebody was asking, does it provide interest? Yes, my dear. Many banks provide interest on salary account as well. Fixed deposit, no, time period is there. Recurring deposit, time period is there. Right? So 1, 2 and 3 are correct. 3 of them are the right option. Hence, the right option for the question will be option B. Everybody is okay? Let's go forward now. Now, what is a banking structure? Let's focus on the simplified banking structure and let's focus only on India. Don't send a mail to me later. Don't comment later saying that this is not the structure in USA. I'm not talking about USA. Let's stick to idea of, right, let's say India. And the person who is asking what is recurring deposit? My dear, in case of fixed deposit, you keep an amount, one shot, you will keep an amount for a specific time period. In recurring deposit, you will keep on making a payment into your deposit once every month like this. Right? According to the scheme that you have chosen, let's say every month you will keep on depositing 5,000 and let's say you have chosen 12-month installments. That is basically called as a recurring deposit. Okay. Now let's go forward. What is a banking structure in India? At the topmost sits the big brother, Reserve Bank of India. Please remember, Reserve Bank of India. RBI is the regulator of India's banking sector. RBI is the regulator of the India's banking sector. RBI plays such a very important role. For example, you want to open a bank, you need to take a license from RBI. You want to open a type of a bank. Which type of a bank? RBI will decide. RBI will also have guidelines regarding how many branches you are allowed to open. RBI will have guidelines regarding what kind of deposits you are allowed to collect. RBI will have guidelines regarding how many ATMs you are allowed to open. Right? RBI will have guidelines regarding whether you are allowed to provide internet banking services or not. And if you do not perform very well, if you are leading to losses, etc., if you are collecting deposits and you are not using the funds correctly, then the RBI can simply cancel the license as well. So RBI is the big brother of banking structure. It is the regulator of banks in India. Now, under Reserve Bank of India, there are different types of banking structures. For example, we have public sector banks, PSBs, public sector banks. Now, please do let me know how many number or what is the number of public sector banks currently operating in India. Do let me know. I'll come to the answer in a minute. So, we have public sector banks. We have private sector banks. The private sector banks can be the domestic private sector banks. These private sector banks can also be foreign private sector banks. Right? Most of you have given the right answer. I'm also happy. I'm very happy, by the way. Right? All of you, in fact, all of you have given the correct answer. That is number 12. Currently, we have 12 public sector banks in India. In fact, Government of India is considering, right, reducing the number, but right now, 12. I'm very happy, by the way. Good. Most of you are studying well. Others, please make a note of this. Public sector banks. We have private sector banks, right? For example, ICICI. It's a domestic private sector bank. Foreign private sector bank. Are they allowed to operate in India? Of course, yes. If they want to operate, listen to me very carefully. The foreign private sector banks, if they want to open multiple branches, they're allowed to open. And lot of these particular foreign private sector banks, they do not want to open multiple branches. Rather, they will open only one office. Even that is allowed. Is my statement clear to all of you? They don't want to open multiple branches. They want to open only one office so that they can say we are present in India. That is also allowed, by the way. Right? So multiple foreign banks right, are operating in India. In addition to this, we have regional rural banks, RRBs. We'll discuss that also, don't worry. I'm expecting a question in the next year from RRBs. RRBs, I'm expecting a question. I'll tell you the reason behind it. RRBs now are going to complete 50 years, right? RRBs are completing 50 years. So automatically they become important. We will have a detailed discussion, important points regarding RRBs. Not now, later on, when you're feeling sleepy, 10, 10:30, 11, that is when RRBs will come knock on your doors. Okay. In addition to this, we have cooperative banks in India. We have got cooperative banks. But listen to me very carefully. Whenever you talk about these kind of banks, for example, cooperative banks, these kind of banks can be scheduled as well as non-scheduled. Please remember this. Can be scheduled as well as non-scheduled, especially cooperative banks. But what is the basic idea of a scheduled and non-scheduled? Whenever you come across the concept of scheduled, it simply means, for example, public sector banks. These are scheduled. What does it actually mean? Scheduled banks essentially means these are registered under Schedule 2 of RBI Act. Schedule 2 of RBI Act. RBI Act of which year? RBI Act of 1934. Right, I repeat, RBI Act of 1934. Because please remember, the powers regarding, right, operations of a bank given to RBI, the composition of RBI, how many people are appointed in the RBI, that is at the management level, right? What is the scope of, right, let's say investments are done by RBI. All of these are mentioned under the RBI Act of 1934. Please remember that number. RBI Act of 1934. That is the mainstay, right, for the functioning of RBI, operations of RBI, composition of RBI. Everything RBI does is derived from the provisions of RBI Act of 1934. I'm emphasizing on this. There is a reason. One, earlier there was a question asked on whether there is a constitutional provision to appoint RBI governor. There is no constitutional provision, by the way. Everything stems from RBI Act. And the second reason why I'm emphasizing so much on RBI Act is, very recently, the new RBI governor, Mr. Sanjay Malhotra, has completed 1 year. The RBI governor has completed 1 year, right? So you should be aware of all of these particular facts. Okay, so scheduled banks, these are registered under Schedule 2 of RBI Act of 1934. Non-scheduled means these are not registered under Schedule 2. Essentially, lot of these cooperative banks, these are non-scheduled. Local area banks, a lot of them are non-scheduled. But the scope of operations, how much is the market share of these particular, right, let's say the non-scheduled banks, the scope of operations, the market share, right, etc. It's very, very limited. It's very small. Most of the work, most of the market share essentially is controlled by the scheduled commercial banks. And when I say scheduled commercial banks, this definition is given under the Banking Regulation Act of 1949. When I say scheduled commercial banks, what do you mean by that? Please understand, there can be commercial banks, there can be differentiated banks, right? There can be differentiated banks. We'll come to that, don't worry. There can be different types of banks. So when you say scheduled commercial banks, these are defined under the, right, Banking Regulation Act of 1949 as those banks which are involved in the collection of deposits and lending activities. Is everybody okay with the discussion so far? So at the top, at the helm of the banking sector sits RBI. And apart from these, there are also many other financial institutions which are called as All India Financial Institutions. Remember this, All India Financial Institutions, AIFIs. Even the AIFI, for example, NABARD is an AIFI. EXIM is an AIFI, right? The NABFID is an AIFI. All these particular AIFIs also come under the regulation of Reserve Bank of India itself. So the big boss in the India's banking sector is the Reserve Bank of India. Is everybody okay with the discussion so far? Now let's enter into RBI. Let's jump into Reserve Bank of India. Expect a question from RBI. Every year, if you have seen the UPSC papers, every year there is a question of RBI. So let's focus on RBI now. What are the important points regarding RBI? Point number one, or before I start, everybody is okay with the discussion so far? Please do let me know in the chat section. Please give me confirmation that you are awake. Please give me the confirmation that you are listening to me. Everybody is okay with the discussion, and listen to me carefully. A lot of you will be focused on writing down everything. Don't write down everything. You will be given the PPT. If you need the notes regarding banking, all you need to do is simply drop in a comment in the comment section or in the chat section. I'll upload my banking notes, download and read. I don't focus on writing down in my session. I don't want you to be writing everything because you will not be able to listen to a lot of things. Okay, now let's start. Those are asking questions about AIFIs, small banks, right, payment banks, etc. My dear, we are going step by step. Have patience. Okay, right. In the words of Shah Rukh Khan in the movie Om Shanti Om, picture to abhi baki hai. We have just started. It's been just 26 minutes. Picture to abhi baki hai. Okay, let's start. RBI, Reserve Bank of India. It was set up based on the recommendation of the Hilton-Young Commission. Now, I've written Hilton-Young Commission. UPSC to confuse you, or any exam just to confuse you, instead of Hilton-Young Commission, might write Royal Commission on Indian Currency and Finance. Right? That is the actual name, technical name of the commission. Please remember this as well. A lot of the books would have written Hilton-Young Commission, but examiner to confuse you will use the term Royal Commission on Indian Currency and Finance. Right? Both are same. Hilton-Young is the name. That's it. Okay. So this was the recommendation of the commission. The government at that point of time introduced an act, right? Introduced a bill, became an act, and that is RBI Act of 1934. RBI Act of 1934. And from the 1st April 1935, we established Reserve Bank of India. To begin with, the Reserve Bank of India was privately owned, but the government back in the year 1949, after independence, 1949, nationalized, please remember the term, nationalized the Reserve Bank of India. What do you mean by nationalization? Rather than the ownership remaining with the private, the ownership got shifted to the government. Right? The government of India has gone for nationalization, not just in banking. After independence, not just in banking, many more sectors have been nationalized. For example, coal sector, right, civil aviation, etc. So nationalization of RBI was done in the year 1949. And to begin with, initially, the headquarters of Reserve Bank of India was present in Calcutta. And in 1937, the headquarters has been shifted to Mumbai. And since 1937, the headquarters is present in Mumbai. Right? These are certain introductory points. Now, I want you to remember these particular sections, at least some of them. Right? What are the important sections associated with Reserve Bank of India? 1. Please remember the section 3. It talks about establishment of Reserve Bank of India. Please remember section 8. It talks about composition of Board of Directors, Central Board of Directors. What is the role of Central Board of Directors? The decision-making process in RBI is done by the Central Board of Directors. Right? Please remember, it is the Central Board of Directors, and it is the section 8 which talks about Central Board of Directors. Section 7 talks about the Government of India consulting RBI and then issuing a direction. Then issuing a direction to RBI, RBI has to follow the order issued by the government. Why is this important? I'll give you a connection here. Earlier, there was a RBI governor by the name Mr. Urjit Patel. How many of you have come across Mr. Urjit Patel in the current affairs? Please do let me know in the chat section. Mr. Urjit Patel, how many of you remember, right? And what was the connection in the current affairs of a connection to the Mr. Urjit Patel? Anybody who can give me the answer? What was the reason why Mr. Urjit Patel was present in the newspaper? IMF. He has been appointed as executive director representing India in IMF. Please remember. In the current affairs, his name popped up because Government of India recommended him to represent India as IMF executive director. Please remember that. Okay. Now come back to the discussion. When it was Mr. Urjit Patel, this was there in the newspapers. Why? Or this discussion was there. The Government of India issued a directive to Reserve Bank of India to transfer more surplus, of their profits to the Government of India. Now, what is this surplus? What is the profit, etc.? We will understand that later. Please don't worry. So, Section 7, this kind of a connection can be established. Mr. Urjit Patel, current affairs, he was the RBI governor. When he was the RBI governor, there was a discussion related to Section 7. Okay. Now, in addition to this, Section 17 is also important. What does RBI do? Where does RBI invest money? Where does RBI get the returns? What is the business of RBI? Can RBI invest in real estate? Imagine in your own locality, there's a, let's say there's a flat, there is a plot. Can RBI bring the money and start purchasing the real estate in your locality? Is it allowed? Absolutely no. Where RBI is allowed to invest the money, there is a restriction. And that is decided under Section 17 of the RBI Act of 1934. Section 21 will discuss more associated with this. The banking affairs of the government is conducted by RBI. Section 22, please remember this. The exclusive rights to print the currency notes. I repeat, exclusive rights to print and issue the currency notes is given to Reserve Bank of India. Exclusive rights. For example, can you print a currency note? Can you simply say, sir, I am sitting, I was feeling bored. You are going about RBI on and on and on. I got bored. So, let's say there was a color printer. I had papers. I printed, let's say, currency notes. Can you do that? Absolutely no. It is illegal. So, who has the right to print currency notes in India? Of course, except 1 rupee note. We'll discuss more about that in some time. It is the Reserve Bank of India. It is the Reserve Bank of India, and that power is given to RBI under Section 22. And one more section, 47, transfer of surplus. We'll discuss about surplus transfer after some time. Don't worry. And I know some of you will simply say, but sir, lot of things you're simply saying, we'll discuss later. My dear, mother promise, I'll discuss. I cannot discuss all the important points only in one slide. Separately, there are headings for the slides. We will discuss it one by one. Have patience. Okay. Now, let's start. Before that, please solve the question and tell me what is the right answer. Please solve the MCQ and tell me what is the right answer. Consider the following statements. RBI was nationalized in 1949 and is completely owned by the government. RBI was recommended by the Hilton Young Commission. The first RBI governor was Mr. Osborne Smith. All the three statements are true. Some of you are saying only 2 of them are correct. My dear, all the 3 are true. All the 3 are correct. Mr. Osborne Smith was the first RBI governor. Let me ask you one more question now. Who is the longest serving RBI governor? Tell me the answer very quickly. Who is the longest serving RBI governor? What is the right answer? Who is the longest serving RBI governor? Anybody knows the answer? It is Benegal Ramarao. And I'll connect it to current affairs. Just give me a second. I'll connect it to current affairs. Sir, what is the connection to current affairs? Last year, Mr. Shaktikanta Das, he demitted office. He completed his term and he was replaced by Mr. Malhotra. If Mr. Shaktikanta Das was reappointed by the government, he would have ended up becoming the longest serving RBI governor. Is my point clear? If he was reappointed by the government, he would have ended up becoming the longest serving RBI governor. Venegal Ramarao served as RBI governor for almost 7.5 years. 7.5 years. Remember it, right? Just factual nugget which can be used in the UPSC prelims examination. And do let me know one more, right? A factoid based question to you. Who was the first Indian RBI governor? Right? I'll repeat the question. Who was the first Indian RBI governor? Who was the first Indian RBI governor? Anybody knows the answer? A lot of you are giving correct answer. I'm happy, by the way. Right? Those who have given the answer, C.D. Deshmukh. Absolutely right. Absolutely right. Right? Good. A lot of you have good amount of content, good amount of knowledge regarding RBI. C.D. Deshmukh. C.D. Deshmukh is the first Indian, right, RBI governor. Okay. Now, everybody is okay with this particular question, right? So, all the three statements are true. Right option is C. Now, let's look at the functions of RBI. Let's look at the functions of RBI, right? What are the important functions? Let's try and understand, right? First one, right? Let me start with the first one. That is issuing the currency notes. Issuing the currency notes. Now, please listen to me very carefully. The currency notes that we are using right now, right? These are basically called as Gandhi series notes. These are all referred to as Gandhi series notes. And if you ask me, sir, why are these referred to as a Gandhi series notes? Let me show you, right, a currency note. Right? Any currency note that you people have, if you open this particular currency note and look at it, right, you will see the bust of Mahatma Gandhi ji. You will see the bust of Mahatma Gandhi ji. That's the reason these are called as Gandhi series notes. And RBI started issuing the Gandhi series notes from the year 1996. And now you will have a doubt. Sir, then before 1996, what kind of currency notes were issued? We had different types of currency notes, a different series of currency notes. But since 1996, all the currency notes which have been issued by Reserve Bank of India are Gandhi series notes. Point number one. Point number two, are all the currency notes printed by RBI? I'm using the term printing, right? Remember the technical term. In the context of the coins, we use the term minting. I repeat, in the context of the coin, we use the term minting. Minting is the prerogative under Reserve Bank of India. Right? Minting is minting is a prerogative under the Government of India. Government of India is having the right to mint the coins. And these are the places where the coin minting is done. And my suggestion, please memorize all of them. Please memorize all of them. Why? A lot of discussion has been happening in the context of coins in India. Right? A lot of these particular coins have been issued as commemorative coins. Have you come across any example of a commemorative coin? Right? The Government of India issued a commemorative coin of 75 face value, 75 rupee denomination. That was to basically commemorate a particular historical event. Right? So I hope you understand this. Lot of the coins are being issued by the Government of India, and these are generally the commemorative coins. Commemorative coins, what is the meaning of it? These coins are issued in order to, right, basically recollect some past event. To basically signify something that has happened in the past, we issue a coin. Right? These are called as commemorative coins. And most of these commemorative coins, I repeat, most of these commemorative coins are, right, basically for collection purposes. These are not for circulation purposes. These are for collection purposes. And that's the reason you will see a lot of these commemorative coins are manufactured using, right, silver. These are manufactured using bronze, etc. And because we are using precious metals like this, the face value of the coins will be very, very high. Is everybody able to understand? The actual value will be very, very high compared to the face value. Face value could be 75. But because you have used, right, precious metals, because you have used silver, bronze, etc., the actual value of the inputs could be 5,000, could be 4,000, etc. These are purely for collection purposes. Is everybody able to understand? right? So minting is done by the government. These are the 4 places, right? And can anybody tell me what is the maximum value, right? Value of a coin which can be minted by the government? What is the maximum value of the coin which can be minted by the government? What is the maximum value? Anybody can tell me? Huh? Let me know. Printing, what is the maximum value? And minting, what is the maximum value? Minting and printing. Minting is 1,000, printing is 10,000. Minting is 1,000, printing is 10,000. In fact, earlier we had 10,000 rupee currency notes. Earlier we had 10,000 rupee currency notes, not the coin, notes. They were there. And when demonetization was done in the past, not the 2016 one, in the past, the 10,000 rupee currency notes have been withdrawn by the government. 10,000 for printing, 1,000 for minting. Okay. Now, like I said, RBI prints currency notes. Not all the currency note, except 1 rupee currency note. Except 1 rupee currency note. Sir, why not 1 rupee? Right? 1 rupee should be printed by RBI, etc. RBI simply says the 1 rupee currency note is not counted as a note, it is counted as a coin. I'll repeat the statement. The 1 rupee currency note is not counted as a note. It is not counted as a note and counted as a coin. That's the reason it is not under the purview of RBI. Rest of the currency notes are printed by RBI. Where is the printing done? Please memorize these particular 4 places as well. Please memorize these particular 4 places as well. That is Devas in Madhya Pradesh, Nasik in Maharashtra, Mysore in Karnataka, and Salbani in West Bengal. These are the 4 places where the currency notes are printed. The first 2 are essentially owned by this entity, Securities Printing and Minting Corporation of India, which is in turn owned by the government. And the next 2, Bharatiya Reserve Bank Note Mudran Private Limited, this is owned by Reserve Bank of India. Right? So please make a note of all of these. UPSC has the habit of asking question on currency coins as well as currency notes. Is everybody okay? Can we go forward? Somebody is asking, why don't we ban 1 rupee note? My dear, in the recent times, Government of India almost stopped printing 1 rupee note. Reason is essentially the cost of printing is becoming higher compared to the face value. That's the reason it has almost discontinued. It is not printing the new currency notes. And in the context of the coins as well, I don't know how many of you have observed it. Have you seen the size of the coins are shrinking? Yes or no? Have you seen the size of the coins are actually shrinking now? Why? In order to manufacture coins, again you require certain inputs. What is the point of spending more money to mint 1 rupee coin, but you're spending more than 1 rupee? So obviously, right, the size of the coins is also coming down. Right? That is the precise reason. Everybody is okay. Now, in the context of currency notes, there is one concept, full reserve versus minimum reserve system. Listen to me carefully. Full reserve and a minimum reserve system. That is, there is a concept of convertibility associated with the currency note. What is this idea of a convertibility? Listen to me carefully. And no, I'm not talking about convertibility in the balance of payments. I know some of you have already revised it. I'm not talking about that convertibility. I'm talking about currency note convertibility. Historically, if you see, there was a system which was followed, which was called as a full reserve system, right? Wherein the banks, whenever they used to print a currency note, they used to keep the same amount of gold with themselves. Is the point clear? Imagine, okay, it is not followed right now, but imagine RBI is printing 200 crore rupees. Now, right, same value of the gold would be kept with RBI. They would keep 200 crore rupees worth of gold. Why? The argument was, if you return the note to RBI, RBI will give you the gold worth 200 crore rupees. That was essentially followed earlier. Right? Then, instead of only gold, they started storing silver as well. That was also not sufficient, because I hope you understand. You cannot keep on holding equivalent value of the gold and silver whenever you are printing. Then we shifted to proportional reserve system. We shifted to proportional reserve system. What happened under the proportional reserve system? Instead of keeping 100% value of the currency notes printed, they started storing certain percentage of the value of the currency note. For example, let's say if they print 100 crore rupees worth of currency note, they would simply keep 40% of this, that is 40 crore worth of, right, let's say reserves in the form of precious metals. But even this is not sufficient, in the sense RBI can't keep on doing this. The central banks around the world cannot keep on doing this. So are they using the full reserve? No. Are they using proportionate reserve system now? No. We have shifted to a concept called as minimum reserve system. We have shifted now. Reserve Bank of India uses the concept of minimum reserve system, wherein RBI is simply keeping 200 crore worth of reserves. That's it. RBI is keeping, or RBI has kept 200 crore worth of reserves. 115 crore in the form of gold, 85 crore in the form of cash. And having this minimum reserve system, now RBI is allowed to print the currency notes and issue them in the market. Is everybody okay with the evolution of the reserve system? Do let me know. Full to proportional, proportional to minimum. And today, right, listen to me carefully. Earlier, what was the logic? If you return the currency note, the RBI would give you equivalent value of the gold. Right? RBI would give you equivalent value of the gold. That is, if you give 200 rupee currency note, RBI would give you 200 rupees worth of gold. Today, it is not meaning that. Today, the currency notes, the paper currency notes are inconvertible. Remember the term. In this context, they are using the term inconvertible. What is the meaning of inconvertible? If you, right, let's say hypothetically, if you're walking in the garden right now with earphones, with the mobile in the hand, you're walking in the garden and you come across RBI governor. You provide him 200 rupees note like this. RBI governor will not give you 200 rupee worth of gold. RBI will give you 200 rupees notes change. RBI will simply give you, let's say 50 rupee currency notes, 4 denomination. RBI will give you 100 rupee currency note, 2 denomination. That is the basic concept of convertibility. And that is exactly what is given in the form of, right, let's say how many of you have seen this? If not, take out a currency note and have a look at it. There is a promise which is written. I repeat, there is a promise which is written on every currency note. You have 100 rupee currency note, take it out and just observe it. There is a promise which reads like this: I promise to pay the bearer equivalent value of 100 rupee, right, etc., etc. So the logic is simple. Those are asking what is the logic behind this, etc. Earlier the logic was you cannot keep on issuing the currency notes without keeping an asset to back it up. Everybody is able to understand? You cannot issue a currency note without having some asset to back it up. Now we cannot keep the same value of the asset. We have reduced it to minimum asset, that is 200 crore rupees. Is everybody okay? Can I move on to the next concept now? And MEP means, is the 200 crore rupee fixed? Yes. Yes, 200 crore is fixed. Is it okay? But then RBI can't give equal value to person goes to the RBI to demand money. My dear, I'll repeat this again. Today the currency notes are inconvertible. Inconvertible means what? RBI will not give you the equivalent value of the gold. No, it has done away with that. Right? What RBI will do now is, if you give 200 rupee, one currency note, they will give you change of 200 rupee. That is, they will give you, right, let's say 2 currency notes of 100. Right? That is the promise which is written on the currency note. Please have a look at it. RBI governor promises to you to pay a sum of 200 rupees. Is it okay? Done? Everybody is okay with the discussion? Let's go forward. Right? Please solve the MCQ now. I want answer from your side. Please don't make a mistake on all of these. Consider the following statements. All the currency notes and coins are printed or minted by RBI. The currency notes or coins by RBI are part of fiat currency. If you have got a doubt regarding this, I'll address it, don't worry. The currency notes are fully convertible in India. Let's start with the first statement. All the currency notes and coins are minted by RBI? No. Printing done by RBI except 1 rupee note. Minting done by Government of India. But please remember, the distribution of the currency notes and coins is done by RBI. Right? The distribution is done by RBI. The currency notes or coins by RBI are part of fiat currency. What is this idea of a fiat currency? Listen to me carefully. The term fiat simply means an order. These currencies are issued through the order of the government. Right? That is the reason these are called as fiat currencies. Is everybody okay? That's the reason these are called as fiat currencies. For example, any currency note that you have right now. Any currency note. In fact, I repeat, even the 2000 rupee currency note that you have, it is a fiat currency right now. It's a legal tender right now. RBI simply says it is still a legal tender. Right? The currency notes and coins, right, are called as the fiat money. Right? Those currencies which are issued through the order of the government, these are called as, right, the fiat currency. And the fiat currencies are used in India as a legal tender. The fiat currencies are used in India as legal tender. What do you mean by legal tender? Whenever you owe certain money to somebody, what is the money that you are using for the settlement? That is called as legal tender. For example, listen to me carefully. Imagine you have a BMW showroom. Imagine, right? You should also become very happy. Evening 7 o'clock, right? So let's make you happy. You own a BMW showroom. I'll come to your showroom. I'll purchase a car and I'll make a payment through check. Right? Is there a compulsion on you to accept the payment through check? Absolutely no. Is my statement clear to you? Right? Everybody is able to understand. Is there any compulsion on your side to accept the payment through the check? Absolutely no. There is absolutely no compulsion. That's the reason we say these are not legal tender in India. But if I transfer money into your account, if I make a payment up to, let's say, 2 lakh rupees or 1 lakh rupees using UPI, etc., there is no other option but to accept. If I make a cash payment of 50,000, there is no other option. You will have to accept. Right? So that is called as legal tender. Right? So fiat money. Come back to the question here. The currency notes or coins by RBI are part of fiat currency. Yes, it is part of the fiat currency. Right? Third one, the currency notes are fully convertible in India. Fully convertible, again I'm saying, does it mean you give, right, let's say the currency note and RBI will give you gold? No. That idea of a full convertibility is done. It's done away now. It is inconvertible types. Okay, so third one is incorrect. Of the three, the first and third is incorrect. Second one is correct. Right option for the question will be option A. Is it okay? Can I move on to the next concept now? Right, CBDC, I'll come to that. Lakshman Maheshwaram, have patience. I think there is one slide with CBDC heading. I'll come to that, don't worry. Okay. Can we go forward now? Done. Let's go forward. And those who are wondering, sir, right, 7 p.m., almost 7 p.m., 1 hour over, when will be the dinner, etc.? 8 o'clock. 8 o'clock, right? 8 o'clock will be the dinner time. Till then, have patience. Like I said earlier, this is going to be a long session. Be ready for that. Let's go forward. RBI also works as a banker to the government, right? What do you mean by the banker to the government? Whatever payments have to be done by the government of India, RBI does the payment on behalf of it. Whatever payments are collected by the government on behalf of the government, the RBI will collect the payment. RBI will help, I repeat, help government of India borrow from the market. RBI will help government of India borrow from the market. Right? What is the meaning of all of this? Let me explain. Government of India every year requires certain amount of money to be borrowed. Everybody is okay with this particular statement? Government requires borrowing to be done. Right? What is this idea of a borrowing to be done? When the government announces a budget, the expenditure is much higher compared to the income. And because there's a shortage, because there's a shortfall, the government of India requires a certain amount to be borrowed. Right? Government of India requires money. So how does government borrow money? Government can borrow from the international market. Government can go outside India and borrow from outside India. For example, it will borrow, let's say, from World Bank. It will borrow from New Development Bank, etc. Right? So it can borrow from external market. It can borrow from external market. It can also borrow from internal market. It can also borrow from internal market. Right? What do you mean by borrowing from the internal market? I'll just give you one example, and that's a most important route, by the way. The government of India issues certain debt instruments. I'm entering into slightly technicality now. Listen with attention. The government issues certain debt instruments, and these debt instruments are technically called as bonds. These are technically referred to as bonds. What do you mean by this? Let's say I'm the government. I will give you one instrument and I'll collect money from you for a duration of 3 years. Is everybody okay? And I'll tell you, give the money for 3 years. I'll give you annually certain interest, and after 3 years, I will return the money to you. Is everybody okay with the concept of debt instrument here? Do let me know right now. Is everybody okay? Please do let me know. Now, these particular instruments can be of short duration. These can be of short duration, and these can be of longer duration as well. These can be of shorter duration and these can be of longer duration as well. Those instruments which are used for shorter duration borrowing, these are called as T-bills. These are referred to as T-bills or treasury bills. They will be used by the government to borrow for 91 days, 182 days or 364 days for that matter. And if the government of India wants to borrow for a longer duration, 2 years, 10 years, 15 years, 30 years, 40 years, they will use dated securities. They will use dated securities. Is everybody okay? And these dated securities are also referred to as government bonds. These are referred to as government bonds. Right? Government bonds are issued to borrow for more than 1 year. Can anybody tell me, those who have revised, can anybody tell me what is the maximum duration of a government bond issued by the government of India recently? Do let me know. Right? Please do let me know what is the maximum duration, and there is a reason why I'm asking you this. The government of India very recently, good. A lot of you are answering correctly. Good, very good. I'm very happy, by the way. Right? The longest duration of bond which has been issued by the government is 50 years. It is 50 years. This is being issued very recently by the government of India. And the reason why the government is issuing a 50-year bond is government says there is a lot of demand from long-term investors in the market. For example, insurance companies, pension fund companies, etc. They have a lot of demand for these kind of bonds. And that's the reason the government is issuing, the union government is issuing 50-year government bonds. Now, this whatever I've explained so far, it is of the central government. It is from central government. Are the states allowed to borrow from the market? Of course, yes. The states are allowed to borrow from the market only by issuing bonds. The state governments are allowed to borrow from the market, of course, yes, but not by issuing treasury bills, but by issuing the bonds. And in the context of the states, please remember, these are called as state development loans. These are referred to as state development loans. Is everybody able to understand the distinction here? Can the treasury bill be issued by the state government? No. They are not allowed to issue treasury bill. Can the bonds be issued by the state government? Yes, these are called as state development loan. Can the central government issue treasury bill as well as a bond? Yes, it is allowed. Now somebody will ask me, sir, what if, right? And the answer is basically addressing the question asked by May 6016. What if the center wants to borrow for a shorter duration? Is there any option? If the state wants to borrow for a shorter duration, is there an option? There is a tool called as Ways and Means Advances, WMA, right? There is a tool called as Ways and Means Advances, WMA. Under the Ways and Means Advances, for a shorter duration, shorter means generally up to 90 days. Generally up to 90 days, the government, be it center, be it state, are allowed to borrow from RBI. Is my statement correct? Is my statement okay with all of you? I'm not asking you correctness. Is my statement okay with all of you? If the states want to borrow for a shorter duration, center wants to borrow for a shorter duration, there is an option, Ways and Means Advances, WMA. What is the logic of having a WMA? Listen to me carefully. If you are the government, imagine you are the chief minister, you will keep on incurring expenditure on day-to-day basis. I'll repeat the statement. If you are the government, you are going to incur the expenditure on day-to-day basis. But the revenue generation is done after certain time period. For example, if you want to collect income taxes, immediately you will not collect income taxes. If you want to collect corporate taxes, at the end of the financial year, you will collect the corporate taxes. But here, the expenditure is incurred on day-to-day basis. So there is a mismatch. I repeat, there is a mismatch between the way expenditure is incurred and the revenue is collected. To address this particular mismatch, the facility of Ways and Means Advances is provided. Right? Ways and Means is provided. Understand the next point as well. Some of you are asking any conditions, etc. What is the limit under WMA? It is decided every year by RBI after consultation with the government. Is RBI charging a rate of interest on this? Of course, yes. RBI charges a rate of interest which is connected to the repo rate. Done? Everybody is okay? Can we go forward now? What is the difference between T-bill? My dear, T-bill is an instrument. Government of India issues them and borrows. WMA is basically borrowing from RBI for short duration whenever the government of India or the state government faces cash expenditure mismatch. Now, what is the role of RBI in all of this? What is the role of Reserve Bank of India in all of this? Listen to me very carefully. Earlier, RBI used to purchase the government bonds directly and give the money to the government. Is my statement okay with all of you? I'll repeat it again. Earlier, the government of India used to sell the bonds to the government. RBI used to purchase the bonds directly from the government and give the money to the government. This was the practice done earlier. But just think of this. If RBI will purchase the bonds from the government, gives the money to the government, don't you think this will lead to increased money supply in the market? Is everybody able to understand the logic here? If RBI will purchase the bond directly from the government, gives the money, this money was printed, let's say. It was not there in the supply right now, was printed by RBI, was given to the government. Government will take the money and will use it for expenditure purposes. So money supply in the economy would suddenly increase and that would lead to inflation. That would contribute to inflationary trend in the economy. So what did the government of India do? Government of India from the year 2006 under FRBM Act, Fiscal Responsibility Budget Management Act. Remember this. I'll repeat it. Under the FRBM, Fiscal Responsibility and Budget Management Act 2006. From the year 2006, the government of India has discontinued this particular practice of selling the bonds directly to RBI. And whenever RBI purchases the bonds directly from the government, please remember the technical term is primary market. The technical term is primary market, right? There are two terms in the financial market, primary and secondary. Primary means you purchase the instruments directly from the issuer. I'll repeat the statement. Primary means you purchase the instrument directly from the issuer. Secondary means the instrument which is already there in the market, it is being traded. It is being again sold or purchased in the market. Is everybody able to understand the difference between primary and secondary? Right now, is RBI allowed to purchase the government bonds in the primary market? No, it is not allowed. It is not allowed. Right? If you want to remember in an easier way, let me use the symbol from the Squid Game. Primary market RBI, no, it is not allowed. Right? Why? It will contribute to inflation. Is RBI allowed to participate in the secondary market? Yes, it is allowed. RBI can go to the secondary market. For example, banks are having government bonds. You people are having government bonds. Right? Can RBI purchase the government bonds from you? Yes, it is allowed. Is everybody able to understand the difference between the primary, secondary, where RBI is allowed to participate, where it is not allowed to participate? Please remember these conceptual differences. Now, right? So basically, what is the role of RBI? The government of India wants to sell the bonds. RBI has a platform. RBI has a platform, right? This particular platform will be used by RBI. Remember the name of the platform, eKuber. eKuber. RBI uses the platform eKuber to auction and sell the government bonds. Right? RBI will simply sell these particular government bonds. Who will be allowed to purchase the government bonds? You and me, individual investors, we can purchase the government bonds. Right? The banks are allowed to purchase the government bonds. Right? The insurance companies, the mutual fund companies, the foreign institutions, these are all allowed to purchase the government bonds through the eKuber platform, which is essentially a primary market for government bonds. Is everybody okay? Please do let me know. And Meep Mind says, by that too will the inflation not rise? My dear, in this particular system, the money which is already there in the circulation is given to government. Whereas in the primary market, where earlier RBI used to purchase, RBI is not there, RBI's money is not there in the system in circulation. RBI will be giving money which is not there in the circulation, that will contribute to inflation. Is it okay? Everybody is able to understand? So right now, this is a system that is used. Hence, I say RBI will help basically the government of India borrow from the market. Is everybody able to understand? Now, let me see how many of you have understood the concept and will be able to answer the question here. Please tell me what is the answer to this question. Consider the following statements. RBI is buying the G securities directly in the primary market, thereby providing the money to the government. RBI buys or sells the government securities in the secondary market. Right option for the question will be, right, the second statement is true. And please understand, I'm using the term buys or sells because according to the requirement, RBI will do one of them. For example, let's say RBI wants to promote growth. Let's say RBI wants to promote growth. Then it can be done by increasing money supply. And how can RBI increase the money supply? One way is to start purchasing the government securities from the secondary market. Is it okay? Right? Start purchasing the government securities from the secondary market. Money supply increases. If RBI wants to control inflation, RBI has a lot of the government securities. They will sell it and take out the money from the secondary market. That's it. Right. So second statement is true. Right option for the question will be option B here. Everybody is okay. Can I move on to the next one? The most important function of RBI. The most important function. This is important. Expect a question from this particular slide. Let's start. Credit control tools or monetary policy tools. Credit control tools or monetary policy tools. Now, what are the, right, let's say the sets of tools. Everybody please have a look at it. Right. Essentially, we have divided the monetary policy tools into two types. Right. We can divide them into two types. On what basis? One set is called as quantitative and the second set is called as qualitative. What is essentially the difference? In quantitative, the tools will be used to either increase or decrease the overall money supply. The overall money supply can be either increased or decreased. Whereas in qualitative, you can target a specific sector. In that sector, you can either increase or decrease the money supply. Is everybody able to understand the distinction between both the set of tools? And when I discuss them individually, you will understand it more clearly, but the definition should be very clear. In quantitative, overall quantity of money will be changed. In qualitative, you can target a specific sector and in that sector, you can change the money supply. Qualitative. Now, let me start with quantitative. I'll go one after the other. Please listen to me carefully. Abhishek Raj, I'll repeat it again. In quantitative, the overall money supply in the whole economy, either you will increase or decrease. Whole economy. You cannot target a specific sector. Whereas in qualitative, can you change the money supply only in agriculture sector? Can you change the money supply only in the housing segment? Can you change the money supply only in retail loans? Yes, you can do that. That is basically qualitative. Done? Let's start now. Quantitative, I'll go one after the other. Listen to me very carefully. First one, cash reserve ratio. What is this cash reserve ratio? Cash reserve ratio basically is the percentage of net demand and time liabilities that the banks will have to keep with RBI. Is my statement clear? I'll repeat it again. What is the cash reserve ratio? Percentage of NDTL. NDTL stands for net demand and time liabilities. Percentage of net demand and time liabilities that the banks will have to keep with Reserve Bank of India. And who will decide what is CRR? RBI. RBI will decide what is the CRR. Is the point clear? Everybody is okay with the CRR? Next one is, right, SLR. Right, don't worry. Don't simply say, sir, you have skipped one of them. Don't worry. I'll go one by one. I'll cover all of them. 1, 2, 3, 4, 5. In fact, there is the sixth one, the standing deposit facility. I'll cover that as well. Standing deposit facility, SDF. Okay. So first one is CRR. Done. Second one I want to cover is SLR. Statutory liquidity ratio. Under the statutory liquidity ratio, the RBI will define certain percentage of NDTL that the bank has to keep with itself. Here it is with Reserve Bank of India and here it is with itself. The bank has to keep it with itself. Is everybody okay with the distinction between both of them? Don't simply say later both SLR and CRR are same. No, both are different. SLR, the bank will keep with itself. CRR, bank will keep with RBI. But in case of SLR, listen to me carefully. In case of SLR, RBI will allow the banks to keep this money either in the form of cash or in the form of gold or in the form of approved securities. In the form of approved securities. What do you mean by approved securities? State government bonds. central government bonds, right? These are approved securities. So you can keep this percentage of NDTL, right? Let's say hypothetically, just to make it abundantly clear for some of you who might be having still a doubt associated with this. Let's say you have collected NDTL of 1000 crore rupees. But please do let me know before I go forward. All of you remember NDTL? Yes or no? All of you remember NDTL, net demand and time liabilities? Right? I started with that. In the first 10 minutes, we discussed that. Right? Imagine your NDTL is 1000 crore. CRR is, let's say, 4%. Then out of 1000 crore, you will have to take 40 CR, deposit this with RBI. And please remember, on this, RBI doesn't pay any interest. On the CRR, RBI doesn't pay any interest. Whereas in case of SLR, let's say it is 20%, hypothetically. I'm using the term hypothetically, meaning imagine this. Whatever the exact number is there right now, you can check it in the website. But my suggestion, you are going to write exams next year, don't memorize it. The number will keep on changing. Okay, so 20%, which means out of 1000 CR, you will have to take 200 CR and keep it with yourself, either in the form of cash or in the form of gold or in the form of approved government securities. Now, although there are three options to you, you can keep it in cash, government security as well as gold. You will essentially choose to invest this 200 crore rupees in government securities. Is the concept clear to all of you? You will choose to keep this 200 crore rupees in government securities. Why? If you keep it in the form of cash, you are not going to earn anything. You're not going to earn anything, right? It's not going to give you any kind of returns. You can invest in gold, but the problem with the gold is volatility. Problem with the gold is volatility. You never know what is going to happen to the price of the gold. And this is not your money, it is depositors' money. So what you do is essentially you will keep this money under, right, let's say the government securities. In fact, it has been seen in many cases. If the RBI says keep 18% of your NDTL under SLR in the government securities, a lot of these banks invest more than 18%. They invest 20% of their NDTL. They invest 25% of their NDTL. What is the logic? The bank simply says, right now, this is the money with me. Deposits are there. It is very risky to give loans. It is very risky to give loans. Lot of borrowers are not repaying. But I don't want to keep the money idle as well. So what I'll do, instead of keeping the money idle, I will invest in government securities. At least I will earn certain interest on it. And please remember, government securities are very, very safe. The Government of India bonds, remember the term, these are also called as gilt-edged securities. The government bonds are also called as gilt-edged securities, right? What is the meaning of a gilt? And I know some of you will be looking at this gilt and say, sir, you have made a spelling mistake, right? It is not G-I-L-T. You will basically say G-U-I-L-T. My dear, no, I'm not talking about that gilt. That guilt every day you people will face. I know that. Every day you look at let's say the Hindu newspapers piling up one upon the other, books piling up one upon the other, right? Let's say Yojana magazines sitting one upon the other, etc. That's a different guilt. In this context, gilt-edged means you must have seen certain books where the corner will be golden coated. Yes, have you seen that? Where the corners would be golden coated. So earlier, the government bonds which were issued used to have gold corners like this. Hence, these are called as gilt-edged securities. Done? Everybody is okay? So government bonds are very, very safe. The most safest in the market. That's the reason the banks, despite having a lower limit, maybe 18 or 19, they will invest much beyond that in the government bonds. Is everybody okay with the concept of CRR and SLR? Can I move on to the next one? CRR is generally fixed in the range of 3 to 15%. It is generally fixed in the range of 3 to 15%. And who is going to decide it? RBI. RBI will decide it. Okay. Can we move forward now? Okay, CRR is done and SLR is done. Now let me go to the fifth one. Don't worry. Second, 4, I'll cover all of them. Open market operations, OMO. Right? Is it 3 to 15% for SLR? No, my dear. SLR is generally much higher. CRR range is 3 to 15%. SLR, it is much higher and there is no range limit as such. Right? RBI will decide what is the rate under SLR. Okay, let's start. Open market operation. What do you mean by open market operation? Under open market operation, the Reserve Bank of India will either sell or purchase government securities. Simple. Under open market operation, under this activity, Reserve Bank of India will sell or purchase government securities. That is called as open market operation. Now, the open market operations generally can be divided into two types. One, where the money supply will change permanently, or where the money supply will change temporarily. Listen to me very carefully. Open market operations can be divided into two types, where the money supply will change permanently and where the money supply will change temporarily. Right? What is the meaning of it? Listen to me very carefully now. Please listen to me very carefully. Imagine I am the RBI governor. Okay, imagine. Right? I should also become happy, no? I've been shouting for last 1.5 hours. So I am the RBI governor, you are the bank. Only one transaction. I repeat, only one transaction. I will purchase the government security from you and I'll give you money. That's it. Is my statement clear? I'll repeat it. Only one transaction. I will purchase the government security from you and I'll give you money. So can I simply say this money which has entered into the system, it is right a long-term supply. Is everybody able to understand? Only one transaction. I'll purchase the government security and I'll give you money. That's it. That's it. Right? So the money that has entered into the system, it is going to be there for durable, right? Or a higher duration now. But on the other hand, there can be one more type of open market operation. And that is basically the fourth, repo and reverse repo. Listen to me very carefully now. What is repo? A lot of the books, I repeat, a lot of the books will simply say repo is the rate of interest. It is the rate of interest that RBI charges on the short-term loans that it will give to banks. Just I'll give you very simple definition and then I'll tell you technical idea. Listen to me carefully. The books will basically say repo means what? RBI will give a loan to you, that is a bank, for short term. Short term means generally up to 1 year and charge a rate of interest. They'll say that is repo. But technically that is not repo. I repeat, technically that is not repo. What is repo? Repo stands for repurchasing order. Repo stands for repurchasing order. Right? Repo is a short form. It is a repurchasing order. Abhishek Raj, my dear, listen to me. I'm simplifying the process. Listen to me carefully. Okay? Repurchasing order. What do you mean by repurchasing order? In the repurchasing order, there are two parties. Parties means there are two sides. There are two parties wherein first party will sell an asset to another party with the promise of repurchasing the asset on a specific date at a specific price. I'll repeat it. Listen. Listening is more important here. What is a repurchasing order? One party means a side. One party will sell an asset to another party with the promise of repurchasing the asset after a specific number of days at a specific price. So give me an example. Let's start. Imagine, just for sake of understanding, okay? Imagine this is an asset, okay? There's a piece of paper which is lying in front of me. Let's use it. Imagine this is an asset. I will sell the asset to you today and I'll collect 100 rupees. But today itself, I'm giving a promise to you. It's a contract, by the way. I'm giving a promise to you. After 7 days, I will repurchase this asset from you and I'll pay you 110 rupees. Is everybody okay with the idea? This is called as repurchasing order. Please do let me know. Even including Abhishek, by the way. Including Abhishek. I want an answer from Abhishek. Right? This is basically the idea of a repurchasing order. So what happens in a repurchasing order? Right? Let's start. There are two transactions. There are two transactions in repurchasing order. In the step 1, I'm using the term step 1. Technically, they will use the term leg 1. Leg 1 and leg 2. Don't worry. Let's not complicate it. Step 1. Here is Reserve Bank of India and here is a bank. The bank will sell a government security to RBI. RBI will pay money. Is the step 1 clear to all of you? Let's say 100 rupees. 100 rupees. Hypothetically 100 rupees. And in the step 2, let's say after 7 days, after 14 days, whatever the duration is. Here is the RBI and here is the bank. The bank will repurchase the government security and will pay money to RBI. Let's say 110 rupees. Is everybody able to understand what will happen under repo here? Do let me know. I want an answer from all of you. Everybody is able to understand what happens under repo here. There are two parties. One party sells an asset to another party with the promise of repurchasing on a specific date at a specific price. So now if you see the transactions, RBI has given 100 and it is getting 110 rupees. Can I simply say 10% rate of interest? Simple. Is it okay? RBI has generated revenue of how much percentage? 10% rate of interest. This is how repo rate is calculated. Is everybody okay? But now tell me, listen to me very carefully. Now tell me, if this is done for 7 days, and here also what is RBI doing? RBI is selling and buying government securities. Everybody is okay? RBI is either buying or selling the government securities. So now tell me, is this open market operation or not? I want an answer from all of you, by the way. Here also what is RBI doing? RBI is buying and selling government securities. Can I call it as open market operation? But let me know now. In this kind of a transaction which has happened here under repo, can I simply say the money supply that is changing in the market, it is for very short duration? Yes or no? Right? Let me know. The money supply that is changing in the market, it is changing for how many days? Only for 7 days. Today, I will give you 100. After 7 days, I'll collect it back from you. So listen to me carefully now. Let's go back to the original idea. Open market operation. What happens under open market operation? RBI buys or sells government securities. But here, RBI can simply conduct only one transaction. That is, let's say, buy and give money to you. That's it. Sell and take the money from you. If that is done, that is called as outright. I repeat, if only that is done, that is called as outright open market operation. Outright means what? Only one transaction. RBI will sell the government security, take the money from you. That's it. Or, not and, or. RBI will purchase the government security, give the money to you. So that kind of a OMO is called as outright. There the money supply changes for a longer duration. Longer duration. Whereas under repo, money supply changes, but that is for shorter duration. Is everybody okay with the concept of open market operation as well as repo rate? Do let me know right now. So RBI conducts only leg 1 or leg 2, not the whole cycle. Yes, my dear. In outright, I repeat, in outright, RBI will conduct only one transaction, either step 1 or step 2, not both of them. But in repo, both the transactions are conducted. Is everybody okay? Can I move on to the next one? Reverse repo rate. In the reverse repo rate, what is done? Exactly different. Exactly, not different, exactly opposite. In the reverse repo rate, exactly opposite. Right? What is exactly opposite mean? Please look at the step number 1 and step number 2 now. Please look at the step number 1 and step number 2. Where RBI is written, make it bank. Where bank is written, make it RBI. Are you able to understand? Look at the step number 1 and step number 2, interchange bank and RBI. So in the step number 1, just a second. In the step number 1, what happens? Instead of RBI, I will write it as a bank, and where bank is there, I'll write it as RBI. Simple. Right? I'll shift. Before you simply say, sir, right, your head is covering that. Your head is covering, move away. I'll move away, don't worry. Right? So here is a bank, here is RBI. So instead of bank selling the government securities, RBI will sell the government security. Simple. RBI will sell the government security and the bank will pay money to RBI. And in the step number 2, exactly reverse process. In the step number 2, exactly the reverse process. My dear Criman Pro 8597, what is a bouncer? Tell me. What is a bouncer? I can't come to your home now, right? So please tell me what is a bouncer. What is a bouncer? What is the difficulty? Don't complicate it. Don't complicate it. It's a simple process. Step number 1, repo. Repo, I'm talking about repo. Step number 1, right? Imagine you are the bank, I am the RBI. Let's talk about repo. What happens in repo? You will sell the government security to me, I'll give the money to you. Step number 2, you will return the money to me, I will return the government security to you. That's it. What is a government security? Bonds. Government security is nothing but bonds. And you people have such very nice usernames, I can't even pronounce it correctly. Right? Again, I'm not criticizing anybody, by the way. Right? It's your right. You keep whatever usernames you want. Right? But please excuse me if I mispronounce your usernames. Okay? So in basically the repo, this will happen. In reverse repo, right? Basically opposite. Right? RBI will sell the government security in the stage 1 and bank will give the money. And in the step 2, right, it will be reversed. That is, RBI will give the money to the bank and the bank will sell the government security back to RBI. Is everybody able to understand? And the person who is asking Basel guidelines, my dear, there's a slide on that also. We will look at it later. You're far away from the, right, let's say, the Basel guidelines as of now. Have patience, we'll reach there as well. Everybody is okay with the repo and reverse repo? Please do let me know. Right? So repo and reverse repo, are they associated with OMO? Yes, they are associated with OMO only. Right? So the next one is bank rate. Let's go forward now. Question is, Anushka Singh, in reverse repo, so RBI borrows excess liquidity. If there is excess liquidity in the market, RBI will increase reverse repo rate. If RBI provides a higher reverse repo rate, banks will be more inclined to keep the deposits, right? Basically, give the money to RBI, earn more rate of interest. That is generally done by Reserve Bank of India. Okay, now listen to me very carefully. When you read a book, a lot of you would be confused between the bank rate as well as repo rate. I'll repeat the statement here. When you read the book, a lot of you would be confused between what is a bank rate and what is a repo rate. Why? Repo rate, they will simply say a rate of interest that is charged by RBI when RBI gives a loan. And the bank rate, they will again say it is a rate of interest charged by RBI when they will give loan. So now you will be confused. There are two different tools, names are different, but the meaning is same. In both the cases, they say the RBI gives a loan and charges rate of interest. Is there any difference? Yes, please listen to me carefully. Listen to me carefully. Repo, can I simply say it's a repurchasing order where government security is bought, government security is sold. It's a contract. It's an agreement. Whereas bank rate is simply a lending rate. I'll repeat the statement, listen to me carefully. Whereas the bank rate is simply a lending rate. That is, RBI gives a loan, charges rate of interest. Is everybody able to understand? RBI gives a loan and charges rate of interest. That's it. That is a bank rate. Repo is a repurchasing order. It's a contract where government securities are bought and sold. Whereas the bank rate is purely a lending, right, instrument where RBI will give a loan and charge a rate of interest. And whenever banks want to borrow for a longer duration, they will use bank rate, not repo. Because repo is generally used for shorter duration, 7 days, 14 days, 28 days, etc. Is everybody able to understand the logic here? Everybody is able to understand the difference between both of them? And just think of this. Under repo, G securities are involved. In the bank rate, G securities are not involved. If you are involved in the process, where do you think rate of interest would be higher? Simple, don't complicate everything. In repo, G securities are there. In bank rate, no G securities involved. Where do you think the rate of interest would be higher according to you? Can I simply say the bank rate? It makes common sense also. Bank rate, why? Purely lending. No G securities involved. No collateral involved. So obviously the bank rate, the rate of interest will be higher compared to repo rate. Is everybody okay with the discussion so far? Now come to another tool, standing deposit facility. Right? Standing deposit facility. Bank rate interest will be higher. Why bank take them? My dear, the banks require money for long duration. Under repo, you will get the loan. No issues. You will get the money from RBI under repo. But you will have to return it after 7 days. What if you want to borrow for 1 year? What if you want the money for more than 1 year? Right? Repo will not give you that feature. There is one more tool, bank rate. That's the reason the bank rate is generally used for long-term lending, repo for short-term lending. Okay, let's go forward. Standing deposit facility. And those who are asking MSF, just give me some time, my dear. I will cover that as well. I'll cover that as well. Have patience. Have patience. I'll cover that as well. Okay, standing deposit facility. What is this idea of a standing deposit facility? It has been introduced very recently. The government of India amended the RBI Act and then allowed the RBI to implement a standing deposit facility. And this was based on the recommendation of Urjit Patel Committee. Urjit Patel Committee. But what is the idea of a standing deposit facility? Under reverse repo, the basic idea is simple. Right? What is reverse repo? The banks will keep the deposit with RBI. Look at the process here. The banks will keep the deposit with RBI. RBI will sell the government security to the bank. Is it okay? Step number 1. Reverse repo, the bank will keep the money with RBI and RBI will basically sell the government securities to the bank. Now imagine a situation. Imagine a situation where the banks want to deposit a lot of money under reverse repo with RBI. RBI does not have sufficient government securities. Possible? Correct or not? Think of it. The banks want to deposit a huge amount of money under reverse repo with RBI. RBI does not have sufficient amount of government security. In that case, reverse repo will not be feasible. Reverse repo is not operational. Reverse repo will actually collapse. So what did RBI do? RBI has introduced a new system called as a standing deposit facility, SDF. And please listen to me carefully. Repo and reverse repo are available only when RBI announces their availability. They are not available throughout the year. I'll repeat the statement. Repo and reverse repo, RBI will simply say, next 14 days, repo facility is available. Next 21 days, reverse repo facility is available. Only for that duration, the facility is available, not throughout the year. So, there is a new tool which has been introduced, standing deposit facility. And, right, remember this particular term. In the name of the tools, I repeat, in the name of the tools, if you come across the term standing, it means the facility is available throughout the year. Is everybody okay with my argument? Do let me know if there's a doubt. In the name of the tool, if you come across the term standing, that facility is available throughout the year. That is, the standing deposit facility is available throughout the year. That is, any day RBI is working, STF is there. But what is the meaning of STF? Under STF, the banks will be depositing their money with RBI, depositing money on which RBI will pay interest to the banks. Is it okay? Right, under the standing deposit facility, the banks will be simply depositing their money with RBI, again, right, for short duration, and RBI will be providing interest on this particular deposit. Right, so there is no concept of G securities here. RBI doesn't have to sell the government securities, absolutely nothing. Right, so this is available throughout the year. Is everybody able to understand? Now I've got a question for all of you. Those who are simply sitting and enjoying the session, let me know. Between reverse repo rate and, right, let's say the standing deposit facility, where do you think RBI will be offering a higher rate of interest? Let me know. Between reverse repo rate and the standing deposit facility, where do you think RBI will pay a higher rate of interest? Most of you have given a right answer, that is SDF. SDF, standing deposit facility. Very good. Why? Logic is simple. In case of reverse repo, there is a government security involved. In the STF, no government security. You simply keep the money. You do not take any kind of collateral from RBI. So, rate of interest under STF will be greater. Is everybody okay with all of these particular tools? Now, there is one more tool associated with this. Right? One person was asking that repeatedly. Let me explain that as well. What is the tool? The marginal standing facility. I'll write it at the top. Marginal standing facility. MSF. Marginal standing facility. What is the idea of a marginal standing facility? Under MSF, the banks are allowed to borrow for very short duration, very short duration, that is overnight. The banks are allowed to borrow for very short duration, that is overnight. Right? For overnight purposes, the banks are allowed to borrow from the Reserve Bank of India. And please understand, banks don't use the MSF very liberally. Right? Reason being, under MSF, the facility is available throughout the year. But RBI simply says, if there is an emergency, don't use it for any purpose. If there is an emergency, you are falling short of the funds, come to me. I'll give you loan under the MSF for overnight purposes. Right? So that is the reason under MSF, because there is an emergency, you have not managed your finances correctly. If you go to the bank, that is RBI, and borrow for overnight purposes under MSF, RBI charges a higher rate of interest. RBI charges a higher rate of interest under MSF. Is everybody okay with the concept here now? All these tools that I've discussed are examples of quantitative set of tools. And those are asking, are there any limits to this? Listen to me carefully. How much you are allowed to borrow under repo, under MSF? Generally, RBI limits it based on the amount of NDTL that you have. Based on the amount of NDTL that you have. Right? RBI decides it, generally restricts it to around 2% of NDTL. So everybody is okay, but listen to me very carefully now. A larger picture. What is a larger picture? Take MSF for that matter. Repo, reverse repo, standing deposit facility, SLR, CRR, right? Open market operation, right? Or STF for that matter. Can I simply say, using all these particular tools, the money supply in the overall market can be either increased or decreased? Yes or no? The money supply in the market, overall market, right? The overall money supply can be regulated. It can be either increased or decreased. Can you show me any example that I've discussed or any tool that I've discussed under this particular slide wherein using the tool you can change loans in agriculture sector? Can you do that? No. Can you use any of these particular tools to change the loans given to, let's say, housing sector? Can you change the amount of loans given to industries, etc.? Absolutely no. That's the reason all these particular tools essentially are referred to as quantitative set of credit control tools. Quantitative set of credit control tools. There is one more name for this: general credit control tools. Is the term okay? General. Right? General credit control tools or quantitative credit control tools. Everybody is okay? Now let me go to the second set of credit control tools, and this is important. Some of these are important, rest of them are just for the sake of information. Now, qualitative set of tools, I have listed multiple types of tools. The most important is the first one. The most important is the first one. That is rationing of credit. Rationing of credit. Right? First and foremost, all of you heard of the term rationing. Rationing simply means distribution. You must have heard of the term ration shop. Correct? You have heard of the term ration shop. Rationing simply means distribution. Now, what is the rationing that I am discussing here? Rationing here simply means, listen to me very carefully, if the banks are allowed to give loans without any kind of a condition, without any kind of a conditionality applicable on them, the banks would not prefer to provide loans to certain risky sectors. They would not prefer to give loan to risky sectors. For example, let's say you are a chief manager of a particular bank. You know it is very risky to give loans to agriculture. It is very risky to give loans to students, because today they will take a loan, they will become graduates, but after that they will simply vanish into thin air. You will have to keep on running behind them so that they will earn the salary and start repaying it. Right? MSMEs, export credit, right? So there are a lot of borrowers in the market who are generally categorized as risky borrowers. They are generally categorized as risky borrowers. So these kind of risky loans, if given a choice, banks would want to stay away from them. Banks would want to stay away. But do you think the government of India as well as RBI should allow the banks to continue to operate this way? That is, if they don't want to give loans to these kind of borrowers, let them not give. No, these are risky, yes, but they require institutional assistance. Institutional assistance. I'll give you an example. Agriculture. In case of India, most of the farming that is done is small and marginal. That is, around 86% according to the agriculture census is small and marginal farming in India. A lot of them, if there is no institutional loan given, that is the banks, if they don't provide loan, they will end up taking loan from informal sources. And that is happening even today as we speak. A lot of the farmers, because they do not have collateral, they do not have a, right, let's say sufficient security, they do not have, right, let's say land, etc., or they don't know how to fill the forms, application forms, etc., they will end up taking a loan from money lenders. So that is the reason what the government of India through RBI, what they've done is they've introduced the concept of rationing of credit. Rationing of credit, the name of the tool specifically is referred to as priority sector lending. PSL. Priority sector lending. What is done under priority sector lending? The mandate is that certain percentage of the loans that are given in a year, certain percentage of the loans which are given in a year by the bank will have to be given to certain specific sectors. Certain types of borrowers will have to be covered under PSL. For generally for the banks, the percentage of the loans target that is given is 40%. 40%. But again, for RRB, for urban cooperative banks, for small finance banks, it is 60%. It is 60%. The books will tell you 75%. As expected, Aman Singh says 75% for RRBs. My dear, please check it. The Reserve Bank of India very recently has cut down for all the types of banks. That is for RRBs, small finance banks, as well as the regional rural banks. Earlier it was 75%. It has brought it down to 60%, by the way. But anyways, right, listen to me carefully. General number that is given is 40%. So 40% of the loans which are issued in a year will have to be given to following types of borrowers. That is agriculture, MSME, housing, export credit, weaker sections of the society, etc. There are totally 8 types of categories under the coverage under the PSL. The banks will have to meet these particular numbers or the targets, that is basically priority sector lending. Out of the total loans issued, how much of the loans, I repeat, out of the total loans issued, how much of the loans should go to agriculture sector? According to PSL criteria, 18%. According to PSL criteria, 18%. Now this is my question to all of you. Can you use only this particular tool to change the money supply, that is the loans which are going into agriculture sector? Do let me know now. Can you use only this particular tool, that is a priority sector lending tool, that is rationing of credit tool, to change how much loans are going into, right, let's say agriculture sector? Vishwanath says no. My dear, why? Savarthi Hema says no. Kriman Pro says no. Why? What is the issue here? That is, instead of 18%, what if I make it 20%? Think of it. Instead of 18%, what if I change it to 20%? Right? Instead of 18%, what if I make it to 15%? Does it not mean only in the agriculture sector the flow of the credit will be adjusted now? Either it will go up or it will go down only in the agriculture sector. Yes or no? All of you are able to understand? Right? Please do let me know. All of you are able to understand or not? I know a lot of you do not have the habit of sitting for longer duration. 2 hours means you will be scratching your head. Scratching your head like this, how, etc., etc. My dear, let's take a simple example. Imagine you are the chief manager of a bank. This year, you are giving 100 crore rupee loans. Right? Total loans. Although I'm using the term loans, technically this is called as ANBC, Adjusted Net Bank Credit. Right? Somebody who is asking break, my dear, 8 o'clock. We'll take the dinner break, don't worry. Now come back to the discussion. Right now, what is the PSL? 40%, which means 40 crore out of 100 crore has to go to agri plus MSME plus export plus student, etc., etc. And right out of these particular 100 crores, how much has to go to agriculture? 18 crore. How much has to go to agriculture? 18 crore. Now, RBI will change the PSL number for agriculture from 18% to, let's say, 22%. Tell me, from 18% the number will be changed to 22%. So don't you think instead of 18 crore going to agriculture, now 22 crore out of 100 crore will go to agriculture sector? Is it not changing the money supply, the credit that is flowing only to specific sector? Can you adjust the credit flow in the specific sector, not overall? The specific sector, can you target? Yes. Can you do the same thing for MSMEs? Yes, you can do that. Can you do the same thing for other borrowers who are classified under the PSL criteria? Of course, yes. So now tell me, are you able to understand the difference between the other set of tools that we have discussed so far? Repo, reverse repo, MSF, CRR, SLR, STF, bank rate on one side, where you could adjust the numbers, but that would change the overall money supply. But now using this particular tool, can you target only one sector, change the money supply in one sector? Answer is yes. Everybody is able to understand. That's the reason these set of tools are called as qualitative set of tools. Or else there is one more name for this. These are also referred to as specific credit control tools. I'll repeat. These are referred to as qualitative set of tools, or else these are also referred to as specific credit control tools. Right? Using these tools, you can target specific sectors. This is the most important one. Please focus on this. In addition to this, there is a variation of margin requirements, right? Regulation of consumer credit. What is this idea? Let me explain. There's a term called as margin, right? What is the meaning of a margin here? Imagine you go to a bank, you will apply for a housing loan. The value of the house is, let's say, 1 CR. The bank will never give you 1 CR loan. Is it clear? Right? Do let me know. Right? Imagine you go to a bank, apply for a loan. Right? The house is worth 1 CR. Right? That is the registered value, or that is the sub-registered value that you want to register in the document. Bank will never give you 1 CR loan. The bank simply says, out of 1 CR, our policy is up to 80%. 80%. Hypothetically, okay? I will give you 80 lakh. Remaining 20 lakh, you will have to put from your own pocket. Right? You will have to put from your own pocket. That money that you will put from your own pocket is called as margin. Is everybody able to understand? That is called as margin. Right? Now you tell me, if the margin requirements are very high, not 20, it becomes 30. It is changed to 40 lakh rupees. It is increased to 50 lakh rupees. If the margin is increased, don't you think demand for such loans will go down? If the margin is reduced, now the bank simply says, you don't worry, the value of the home is 1 CR, I will give you 90 lakh. I will give you 90 lakh. You put only 10 lakh rupee from your pocket. When the margin requirements will go down, you will find it very easier to take these kind of loans. You will use the loan to purchase the housing units. You will use the loans to purchase car. You will use the loans to purchase many other items. So now everybody is able to understand how the margin can be utilized by the RBI. How margin changes will lead to changes in the demand for certain types of loans. Is everybody able to understand? Do let me know. So again, the logic remains the same. Can you use this policy to target specific kind of loans in the market? Imagine, RBI feels there is too much demand for, right, let's say housing loans. Too much demand for vehicle loans. And that is causing inflation. That is contributing to inflation. RBI will simply say, increase the margin. Increase the margin for the loans. Automatically the demand for the loans, such kind of loans will go down. Right? If the demand goes down, inflationary pressure will also go down. And on the contrary, if RBI wants to increase the demand for housing units, if RBI wants you to purchase more and more vehicles, etc., RBI will ask the banks to reduce the margin. Right? Reduce the margin requirement. You will have lesser amount of money from your pocket to be put in. Now the demand for these kind of loans, these kind of products automatically will increase. So according to the requirement, RBI can change the margins. Is everybody okay? Right? So margin requirement. Regulation of consumer credit. Right? What is this idea of a consumer credit? Right? Let me give you an example. When you take a loan, right? When you take a loan from a bank, there are different types of policies that can be used. I'm focused on one example here. Consumer credit means whenever you take loans for purchasing products, the goods in the market. For example, you want to purchase a car, you want to purchase, right, let's say a dishwasher, you want to purchase a TV, AC, etc. These are consumer goods, by the way. So let's say there is very high demand or lesser demand, both the situations. What RBI can tell these particular banks is, offer the loans in such a way that, imagine if RBI wants you to take more loans for purchasing consumer goods, RBI will tell the banks, when you give a loan, there is a concept of EMI, equated monthly installments. All of you heard of this? EMI, equated monthly installments. So RBI will direct these particular banks, increase the number of EMIs so that per month the burden of the loan repayment on the borrower becomes lower. Simple. Instead of making a payment of, let's say, 30,000 rupees every month, now the bank will say, don't pay 30,000, take a loan, pay 20,000, but the loan duration will be a bit longer. And this will help the borrowers. Why? Think of it. A lot of the borrowers will find it very difficult to pay 30,000 every month. Lot of the borrowers. Don't look at yourself and simply say, no, sir. For me, 30,000 is a chiller amount. Right? 30,000 is a spare cash for me. My dear, not everybody is as privileged as you. Not everybody is in the top 1% or the 10% of the bracket that you belong to. Lot of middle class households find it very difficult to pay EMI of 25k, 30k, even 15k for that matter. So imagine they are given this kind of a flexibility. RBI wants you to take more loans. So the banks will offer you the EMI component lesser, duration of the loans longer. Don't you think this will promote more and more loans to be taken from the banks? And if RBI wants to do exactly opposite, they will ask the banks to increase the EMI component. Is everybody okay? Right? This is basically how regulation for the consumer credit can be done. Right? Please do let me know. Everybody is able to understand, right, how these particular tools can be used to target specific types of loans. Not overall money supply, but specific types of loans. Right? Couple of more, then we will take a break. Simple information. Publicity. What is publicity? RBI will basically use media. It could be a print media. It could be, right, a TV media, etc. RBI will use a different media to give information to consumers. It could be regarding the rate of interest. It could be, right, regarding the change in the policies of RBI, etc. That is called as publicity. Right? What is moral suasion? Moral suasion equate with your studies. It will be easier. Moral suasion. You must have seen in your own household, your parents will be observing you very, right, let's say very frequently, especially your father. Right? Your father who has paid huge amount of money for you to get coaching, etc. He will keep on looking at you every day. Whether the, right, let's say whether son or daughter, are they reading Hindu newspaper or not? Are they revising or not? Are they appearing for the weekly test or not? And one day they will catch hold of you and ask you, what is the progress? Now listen to me carefully. Moral suasion means RBI basically will try to convince you. RBI will basically say, these are the guidelines. You're supposed to meet 40% PSL, but you're not meeting the guidelines. Please don't do that. Right? You are not going to meet this year. Ensure that by the end of this year, you will meet the conditions. That is either write a letter, right? Send a warning letter, right? Publish something, give a statement, right? Basically trying to morally change your behavior. Try to, right, basically console you, asking you to do the correct thing, follow the guidelines. This is called as moral suasion. But imagine your father tells you, what are you doing? Please focus on your studies, etc., etc. Now you will not listen. You'll simply say, I am adult now. I'm over the age of 18 years. Nobody can tell me anything, right? I'm adult under the eyes of the law, etc. And you will argue, I've studied already this under the fundamental rights, etc. Then your father will simply say, my roof, my rules. Either my way or highway. This is exactly what the RBI will say. RBI will simply tell you, okay, I try to reason with you. I try to tell you to follow the guidelines. You're not following them, you're violating them. Okay. Now you want a loan from me. I will charge 4% for all the other borrowers. I will charge you 6%. Simple. For rest of the borrowers, I'm charging 4%. You want a loan from me. I'll give you a loan. I'll charge you 6%. What will you do? Right? So direct action, penalization if you are not going to follow the guidelines despite RBI following moral suasion first. Is everybody able to understand? So these are the different types of tools which are used by Reserve Bank of India. Right? So time is exactly 8:05 now. Let's solve this particular question and then we can take a break. I know a lot of you are waiting. Some of you are waiting. Some of you said, right, Jane chhod do, right? Let him keep on teaching. I'll keep on eating. Please solve the question and then we can take a break. Math 6016, direct action. My dear, direct action essentially means RBI taking certain action in the form of imposing penalties, in the form of charging a higher rate of interest on the erring banks. Done? Okay. Please solve the question and then we can take the break. How many of the following are likely measures undertaken by RBI to control inflation? To control inflation. Okay. Increase repo, reduce SLR, and buy government securities under open market operation. Some of you are saying option A. Some of you are saying option C. Right? There are absolutely no takers for option B as well as option D. Please take up. Somebody say option B also. Somebody say option D also. So that finally we can say Anekata mein ekata Bharat ki visheshata. Okay, let's start. What are the following actions? Right? How many of the following actions can RBI take in order to control inflation? Control inflation means money supply has to go down. Increase the repo. Yes, if RBI increases the repo, automatically it will increase the rate of interest that is used by the banks to borrow and they will charge a higher rate of interest. That will help in reducing the money supply. Yes. Reduce SLR. If RBI reduces SLR, the banks will have to keep lesser amount of money with themselves and that will increase the money supply in the economy. You can't reduce inflation by increasing the money supply. So, no. Buy government securities under OMO. RBI will purchase the government securities and give money. So when RBI gives money, the money supply in the economy increases. And when the money supply increases, it will add to inflation, not control inflation. So third one is also incorrect. So first is correct. Right option for the question will be option A, only one. Is everybody okay with the question here? Please do let me know. Is everybody okay? This is the most important part of RBI. Couple of more things, right? Just certain conceptual things regarding RBI, and then we will enter into other aspects of banking. That is lending rate regimes, right? The Basel guidelines somebody was asking, regional rural banks, the small finance banks, etc., etc. We will understand them right after the dinner break. Don't worry. Okay, right. So let's take the dinner break now. So time is 8:08. Everybody is okay with a 30-minute break? Please do let me know. 8:38, 5-minute break. My dear, please have dinner. I should also have dinner, no? Right? Motion at peak. Motion at peak. My dear, I should also have dinner. Please spare me also some time. Okay, so time is 8:09. Let's take, let's say 29 minutes now. Let's restart at 8:38. Okay, so the session will restart. I'll write it. Session will restart at 8:38 p.m. Take a break. I'll come back. Let's restart. Let's meet right at 8:38. Okay. Okay, welcome back. Am I audible and visible? Please do let me know. Those who are present in the session, please do let me know. Am I audible and visible? Done. Let's continue. Let's continue. Now, for the next 1.5 hours, please sit and listen carefully. What are the other important functions of RBI? RBI is a banker to the banks and the bank of last resort. What's the meaning of this? Any bank can go to Reserve Bank of India and borrow from Reserve Bank of India. They can take a loan from Reserve Bank of India. That's the first important point. But why it is called as a bank of last resort? RBI is called as a bank of last resort because whenever there is any kind of emergency, you can always, again, when I say you, I'm talking about a bank. Don't simply say, sir, can I go to RBI tomorrow as an individual and borrow from RBI? No, individuals are not directly dealt with RBI. RBI will deal with the banks. Banks will deal with individual borrowers. So a bank, whenever there is any kind of emergency, they can always approach Reserve Bank of India and borrow from Reserve Bank of India. Because RBI is available even in case of emergency, RBI is referred to as Bank of Last Resort. And as already mentioned, RBI is the regulator of the banking sector. Who is allowed to operate as a bank? What kind of operations are allowed? What kind of loans are supposed to be issued? Whether you are allowed to collect deposits, if yes, up to what limit, etc. All of that is decided by RBI. So RBI is referred to as banker to the banks and bank of last resort. Done, everybody is okay. Next, RBI is also referred to as a manager of forex reserves. RBI manages the forex reserves. Now, what are the components of forex reserves? Essentially, the forex reserves will have four components. One is foreign currency assets. There are foreign currency assets. For example, dollars, right? For example, yen, euro, and not just the currencies. There are also the foreign currency denominated instruments. For example, very recently, this was there in the discussion, RBI has reduced the amount of US government bonds. I repeat, RBI has reduced the amount of the US government bonds that it was holding until very recently. So it's not just that the currencies are there in the forex. In addition to the forex, that is the currencies, in addition to that, many other instruments of foreign currencies are also held by RBI. So one is foreign currency asset. Second one is gold. RBI purchases or RBI has purchased a huge amount of gold. The gold RBI has purchased is kept in the domestic market. A lot of gold is also stored outside India. Very recently, this was there in the newspapers as well. So gold. Third one is the reserve tranche position. Reserve tranche, or else this is also referred to as gold tranche. Reserve tranche or gold tranche. Right? Basically under the IMF, the government of India, right? Any member country under IMF is allowed to borrow up to 25% of its quota. That is called as a reserve tranche, or else it is also referred as a gold tranche. And the last component of forex reserves is STR, special drawing rights. These are the notional assets which are issued by the IMF to all its member countries. So when you put together all of these are called as forex reserves. And who manages the forex reserves in India? The management of forex reserves is conducted by Reserve Bank of India. Is everybody okay with the discussion? Please do let me know. So these are some of the very important functions of RBI. Please solve the MCQ now. Please solve the MCQ. Which of the following are part of forex reserves held by Reserve Bank of India? Gold tranche, US government bonds, Indian government bonds, gold held outside India by RBI. How many of these are essentially, right, which is the right option? Please do let me know. Okay, some of you are saying option D, some of you are saying option B. Right now it is basically between B as well as the option D. Okay, most of you are shifting to option B now. Let's solve it. Gold tranche, is it part of the forex reserves? Yes, gold tranche is part. I told you four components. Gold tranche or reserve tranche. I'm saying reserve tranche. Suddenly in the UPSC prelims examination, they might write reserve tranche position, RTP. That is also right, basically a component of Forex reserve. US government bonds, yes, US government bonds are part of the Forex reserves held by RBI. Indian government bonds. Indian government bonds are not part of Forex reserves. Right? A lot of you have, right? Listen to me carefully. A lot of you have made a mistake here. Indian government bonds are not part of the Forex reserves. Right? It is basically part of domestic investment, domestic assets, but not a part of Forex reserves. Fourth, gold held outside India. Gold held outside India by Reserve Bank of India. So RBI has kept on purchasing huge amount of a gold. And this particular gold, whether it is held in India or outside India, doesn't matter. It is counted as a part of the Forex. So fourth one, correct. So 1, 2 and 4. Right option for the question will be option B. A lot of you have said option D, no, option B. Is everybody okay? Please do let me know. Please do let me know. And those who are joining now after the break, after the lunch break, why 4? My dear, gold is purchased by RBI. Whether RBI keeps the gold in India or outside India, it is counted as part of Forex reserves. It is part of the Forex reserves. It is just a matter of fact that it is not stored in India but outside India. Right? Somebody is asking why gold is kept outside India. Multiple reasons are there. Historically, if you see, a lot of this particular gold that RBI purchases, not just in India, outside India. For example, in London, right, the standard gold bars are sold in the London market. When you purchase it in London, you basically keep that, right? The gold you purchased, you keep that in the London itself. That is the central bank. The central bank storage facility in London, you keep it there only because you do not want to move it back to India. It will lead to additional expenditure in transportation. You do not have sufficient storage facility in India. So you have kept a lot of gold outside India. In recent times, there was a discussion associated with this only. Lot of this gold, now RBI started to bring it back to India. RBI started to bring it back to India. Why? It is worried that the Western countries might impose sanctions. Just like they've imposed sanctions on Russian assets, they might even impose a sanction on, right, let's say, government of India assets. So that is the reason they have started moving it back into India. But anyways, right, everybody is okay. Let's go forward now. Right, last one associated with RBI. Then we will shift to other parts of banking. Controlling inflation. Is it a function of Reserve Bank of India? Yes. Yes. 2016, please remember all of these particular points. 2016, there was an agreement that was signed between the Government of India as well as RBI. And that agreement is called as Monetary Policy Framework Agreement, MPFA. Monetary Policy Framework Agreement. According to this particular agreement, the Government of India, once every 5 years, after consulting with RBI, will announce a target rate of inflation. Will announce the target rate of inflation. Right? This particular target rate of inflation has to be met by Reserve Bank of India. The first 5 year was implemented from 2016 to 2021. In fact, the agreement was signed in 2015, enforced in 2016. Okay. So 2016 to 2021, first 5 years. From 2021 to 2026, this is a second round of 5 years. So next year, when you're going to write the prelims examination, this will be there in the discussion. Right. So under this, the Reserve Bank of India has been given the target of maintaining inflation at 4%. Which type of inflation? It is headline CPI. Is the point clear to all of you? Remember all of these particular points. Headline CPI. RBI has to maintain 4%, right? Headline CPI. But you can't maintain exactly 4% all the points or all the times. So there is certain flexibility that has been provided. That is 4% is the rate, but you will be allowed a flexibility. I'm using the term flexibility. They will also use the term legroom. you'll be provided with a legroom of 200 basis points on the either side. You can allow the inflation to reach maximum 4% plus 200 basis points, that is 6%. 4% minus 200 basis points, that is 2%. So the maximum and the minimum ceiling rate for the inflation target is 2% and 6%. Right, so this is basically right the role of Reserve Bank of India in terms of controlling inflation. Is everybody okay with the function of RBI here? Please do let me know in the chat section. Is everybody okay with the role of RBI in controlling inflation? Can I move on to the next one now? Okay, now solve the question. Consider the following statements. RBI is responsible for controlling inflation. The inflation target system has been introduced since 2016. The MPC decisions are taken by RBI members only. MPC stands for Monetary Policy Committee. Monetary Policy Committee. Now listen to me very carefully. Under the current system of Monetary Policy Committee, there are 6 members. There are 6 members in the Monetary Policy Committee. 3 of them are from Reserve Bank of India. And the remaining 3 of them are experts appointed by Government of India. Appointed by Government of India. Okay. So MPC decisions are taken by RBI members only. No, this is incorrect. The third statement is incorrect. First statement is correct. RBI is responsible for controlling inflation. Right. Rabishiva. My dear, you are saying option A. Someone 24A. Right. You are saying option C. Do let me know why. Right. So inflation target system has been introduced since 2016. Since 2016, yes. Since 2016. Agreement was signed in 2015. Right. It has been implemented from 2016. Right. So first statement is correct. Second statement is correct. Right option for the question will be option B. Introduced in 2015. My dear, agreement was signed in 2015. Agreement was signed in 2015, but the implementation started in 2016. Implementation started in 2016. Okay. Done. Let's go forward. Right. Next concept. Money supply or monetary aggregates. Money supply or monetary aggregates. Math 016. RBI governor just casting vote or he's a member too? My dear, RBI governor is a chairperson, member and a chairperson. The casting vote will come into picture when there is a tie. I'll repeat the statement. The casting vote will come into picture when there is a tie. That is, there are totally 6 members, right? 3 from RBI, 3 experts. Now, let's say out of 6 members, 3 are voting in favor of increasing the interest rate. 3 are voting in favor of maintaining the same repo rate. What should be the decision then? When there's a tie, RBI governor is given a casting vote. That is to break the tie. That is basically the concept of casting vote. Okay. Manisha Mukherjee, can you please repeat the IMF policy on gold tranche? My dear, under IMF, there's a tool called as a gold tranche or reserve tranche. Right? This is called as gold tranche because earlier it was associated with the gold, but not today, don't worry. What is this idea of a gold tranche? Every member country under IMF has a quota. Quota means, right, some amount that you have to contribute once you become a member. Right? Using quota, you determine how much is your contribution. Let's say hypothetically 100 crores. Up to 25%, I repeat, up to 25% of this quota, that is 100 crores, you can borrow from IMF without paying any charges, without coming under any conditions. That is called as a gold tranche. Right? That is called as a gold tranche. Okay. Next one. Money supply or monetary aggregates. Right? What are the important points under this? Please have a look at all the aggregates. Don't do a PhD in all of this. Simple logic. M0 is the total amount of money that is supplied in the economy by RBI. It could be in the form of currency notes as well as currency coins. M0, that's a reason, is referred to as monetary base. This is referred to as monetary base. They will use the term either monetary base, they will also use the term high powered money. They will also use the term high powered money, monetary base or high powered money. Right? So RBI will distribute currency notes as well as currency coins. All of that essentially will come under M0. Right? Now, apart from M0, we have more indicators: M1, M2, M3 and M4. M1 and M2 generally are referred to as narrow money. M3 and M4 generally are referred to as broad money. What is the basic idea for narrow and broad? Out of the total money that is being supplied in the economy, when you look at the money which has very high liquidity, I repeat, if you look at the money which has very, very high liquidity, that is called as narrow money. Now, what is the meaning of liquidity? Liquidity simply means how quickly can you convert this into, right, let's say, rupees in the market. How quickly can you convert this asset into money in the market? For example, please do let me know, between savings bank account and fixed deposit, can I simply say savings bank account has more liquidity? Yes or no? I want answer from all of you. Please wake up and participate. Right? Please wake up and participate. Between the savings bank account as well as the fixed deposit, can I simply say savings bank account has higher liquidity? Because you can convert this amount which is there in the account into money very quickly compared to the money which is lying in the fixed deposit, which will take certain time period. So that is called as a liquidity. So now tell me, can I simply say if you have cash, if you have money in the savings bank account, and if you have money in the fixed deposit, can I simply say cash and the money in the savings bank account will have very high liquidity compared to the money that is there in the fixed deposit. Everybody is able to understand the idea here, right? Don't, right, complicate the things. Keep it very simple. The money which is there, right, RBI will print, let's say hypothetically. Listen to me carefully. Let's say RBI prints hypothetically 100 crore rupees. And that 100 crore rupees will come into circulation. Now, this particular money either will be there in your pocket in the form of cash, or this will go into a bank in the form of either fixed deposit or in the form of savings bank account. Or else there is one more option. The same money can also go into postal bank deposits. Now, some of you might be thinking, sir, why are you talking about banks? Why are you talking about deposits here? Is there any importance to this? Simple. RBI wants to know if they print 100 rupee and supply this 100 rupee in the market, the overall money supply will change by how many rupees? I'll repeat the statement. RBI wants to know if it will print 100 rupee and issue the 100 rupee in the market, the overall money supply will change by how many rupees? And those who are thinking, sir, if you print 100 and supply 100, overall money supply will change by 100? No, that is not how the money works. Let me give a very simple example. Imagine RBI has printed 100 rupee. That 100 rupee will come into my hands. I will take the 100 rupee, deposit this 100 rupee in the bank. Now the bank will take 100 rupee, assuming no reserve, nothing. Bank will take 100 rupee, give it in the form of a loan to a borrower. Now don't you think in the economy, there is 100 rupee that I am claiming I have got in my bank account. And there is also somebody who is saying, I have got 100 rupee cash in my hand. So the overall money supply is not 100 here now. Overall money supply has become 200 rupees. So argument is simple. Because of the banking system, the money will be circulated in the form of loans, etc. This is referred to as a fractional reserve system. I think there is a term here. Yeah. This is referred to as a fractional reserve system. Please remember, fractional reserve system. What is the basic idea of a fractional reserve system? Part of the deposits collected by the bank. I repeat, part of the deposits collected by the bank will use it for lending purposes. The bank will use it for lending purposes. And right, the remaining small part, they will keep it with themselves in the form of reserve. And this particular process of keeping small part in the form of reserve and the remaining giving it in the form of loan, this is called as a fractional reserve system. Is it okay? I'll repeat it again. Somebody says did not get it. My dear, you have 100 rupee. You will deposit this in the bank. The bank will take 100 and let's say keep 10 rupees in the form of CRR and SLR. Remaining 90 rupees, now they will be used it to give loan in the market. Now this particular loan, let's say hypothetically, I will take it from the bank. I will take the 90 rupee loan from the bank. I will purchase a machine from the market. I will give 90 rupees to the company from which I have purchased the machine. Now the company will take the 90 rupee, deposit this in the bank. Now the bank, it has collected 90 rupees. They will keep, let's say, 10 rupees out of it in the form of reserves. And the remaining 80 rupees, they'll give it in the form of a loan again in the market. This concept where part of the deposits are kept in the form of reserve and the remaining amount is given in the form of loan is called as fractional reserve system. So RBI could have printed only 100 rupees. Imagine, RBI could have printed only 100 rupees. But in the economy, you are saying you have 100 rupees in the bank. Right? The company which has deposited 90 rupees in the bank, the company says they have 90 rupees in the bank. So essentially the 100 rupee will get circulated again and again in the economy. This is basically the concept of money multiplier. Is it okay? Everybody is able to understand now? This is basically the concept of money multiplier. That is, in simple way or in simple terminologies, if RBI will print 100 rupee and supply it, as a result of the fractional reserve system followed, what is the total change in the money supply? What is the total change in the money supply? That measurement is called as money multiplier. Is everybody able to understand? That measurement is called as money multiplier. Let's say RBI will print 100 rupees and as a result of the fractional reserve system, now the total amount of money in supply in the Indian economy becomes 500 rupees. Then my dear, 500 divided by 100, money multiplier becomes 5 times. The money multiplier becomes 5 times. Is everybody able to understand the logic behind it? Do let me know right now. Now, how does RBI calculate money multiplier? How does RBI decide, right, whether to increase the money supply, decrease the money supply, etc.? They calculate indicators, right? Money aggregates or monetary aggregates. M1, M2, M3, M4, right? In addition to M0. M0, like I said earlier, refers to the total amount of money printed, right, minted and distributed. Be it currency coins, currency notes, which are issued in the market by RBI, all of them are counted as a part of M0. Now, what is M1? M1 is called as narrow money. How do I calculate M1? Simple. Out of the total money that is being circulated in the economy, either the money will be circulated in the form of cash that is there in your pocket, or in the form of a fixed deposits in the banking sector, or in the form of savings bank accounts in the, right, let's say banks, etc. So out of all the money that is there in the system, I will try and find out how much of the money has very high liquidity. How much of this money has very high liquidity, right? For example, let's say, like I said earlier, imagine RBI has issued 100 rupees. Total amount of money supply in the economy right now is 500 rupees. Out of 500 rupees, let's say 100 rupees is the cash or the currency that is being held by you and me? 100 rupees. 150 rupees is the demand deposit, and remaining, right, 250 rupees is the time deposit. Now, please do let me know. Can I simply say, if I number them 1, 2 and 3, listen to me carefully now. If I number them 1, 2 and 3, can I simply say 1 and 2 have very high liquidity compared to 3? Let me know the answer to this question. I'll repeat it. If I number them 1, 2 and 3, can I simply say 1 and 2 have very high liquidity compared to 3? So, out of the total money supply, I will focus on the money which has very high liquidity. That is M1 for you. That is basically M1, narrow money. The cash or the currency held by the public plus the demand deposits. Why demand deposits? You can withdraw them at any point of time. You can simply withdraw them at any point of time. Right? But there is also one more type of a deposit, post office savings deposit. Please observe now M2. In M2, I've taken M1 as it is and I've added post office deposits. Why separately have I added post office deposits? In India, the households save certain amount of money and keep deposits in the post offices. But listen to me carefully now. Can I simply say post offices cannot create loans in India? Correct? All of you able to understand? The post offices do not give loans. They do not create loans. Hence, what I do is, any money that is deposited in the post office, I'll take that. I will take that into calculation. But because they are not creating loans, I will simply calculate one more indicator, adding post office deposit to M1. And that is called as M2. But for all the calculation purposes, now can I simply say M1, right, is a better indicator to find out change in the money supply compared to M2. Because if RBI wants to calculate, if I supply 100 rupees, what will the change in the narrow money? It is better to look at M1 because the credit creation happens under M1, not under, right, specifically M2 because there is a post office deposit. Now, M3 and M4 are called as broad money. M3 and M4 are referred to as broad money. Right? What is this idea of a broad money? In addition to counting the money which has very high liquidity, you also consider the money which has lesser liquidity. That is, you take into account the currency with the public. You consider demand deposits. And in addition to that, you also count time deposits. You count the time deposits. So M1 plus time deposits is called as M3. It is a broader money, right, calculation. Broader money. It is broad money. Broad money means what? In addition to the money which has very high liquidity, we are counting money with lesser liquidity. Right? So now is it okay if I say M1 and M3 are the most important indicators used by RBI? And what is the use of this? Listen to me carefully. Some of you might be thinking, sir, okay, we have calculated all these indicators. But what is the use of the indicators? Now listen to me very carefully. If you are the RBI governor, time is 9/7 by the way, congrats, you have become RBI governors. If you are the RBI governor, if people are holding more and more cash with themselves, they're not keeping money with the bank, they're keeping more and more money with themselves, currency with the public, it is increasing. Don't you think that's an indicator that the people are basically keeping the money in order to spend and purchase more and more goods and services? Correct? If you do not have the objective of purchasing goods and services, why will you keep money with yourself in that case? Simple logic. If you do not want to purchase, why will you keep money with yourself? Rather than, right, let's say keeping money with yourself, you will go deposit that. Especially if you're somebody who doesn't want to purchase anything for the next 6 months, next 8 months, next 12 months, you'll basically take the money, deposit that in the bank in the form of FDs. Right? Everybody is able to understand the logic behind this. If you're somebody who wants to purchase goods, if you want to consume something in the near future, immediate future, then either you will keep the money in with yourself in the form of cash, or else you will keep it under the SB account. That is the demand deposits. But let's say the cash with the public is stagnant, demand deposits is stagnant, but now the term deposits or the time deposits held by the banks are continuously increasing. Don't you think, as a RBI governor, here is an indication for you? What is the indication? People are not interested in buying goods and services. People are not interested in spending, right, immediately. They want to basically postpone their consumption. Don't you think that's an indicator, right, to change the policies according to the requirement? Is everybody able to understand the logic behind these indicators? Please do let me know. Everybody is able to understand how does RBI use these particular indicators, etc. Right? So what does RBI do? Essentially, RBI will take M3. M3 is the broad money. RBI will take M3 and divide this by M0. That is basically the high-powered money or monetary base. If they change the monetary base or high-powered money by 100 rupees, because of the circulation, how much will be the overall change in the right money supply? That is M3. That will give you money multiplier. That will give you money multiplier. Right? So this is right the monetary aggregates, concept of money multiplier, right, as well as right the concept of fractional reserve system. Right? Everybody is okay? Can we solve a question associated with this now? Please solve the question and tell me what is the correct answer. Please solve the question and tell me what is the correct answer. Under how many of the following circumstances the money multiplier would increase? Right? Under how many of the following circumstances the money multiplier would increase? Increased CRR, lower SLR, higher repo. Under what of these, how many of these circumstances money multiplier will increase? Some of you are saying 1 only, some of you are saying 2 only, some of you are saying option A, right, etc. Let's start. If you want to increase the money multiplier, then you will have to increase money supply. Simple. Logic is simple. Don't complicate it. If you want to increase the money multiplier, you have to increase the money supply. If you increase the CRR, do you think money supply increases? Do let me know. Somebody said only the first one. If you increase CRR, that is RBI increases CRR, the bank will have to take more of the deposits, give it to RBI. Where is the increase in the money supply? It doesn't increase money supply. Rather, money supply decreases. First, incorrect. Lower SLR. Lower SLR. Statutory liquidity ratio will be lowered. If SLR is lowered, don't you think the bank will have more money now? If the bank has more money, it will start to lend more. If it will start to lend more, it will contribute to increased M3. That is, overall money supply in the economy increases, and that will increase money multiplier. Correct? Everybody is okay? Second one is correct. Higher repo. If RBI increases the repo, banks will take lesser amount of loans. Simple, because the rate of interest is higher. And when the banks will take lesser amount of loans, right, the lending activity would be affected. And if the lending activity is affected, right, you don't expect more, right, let's say circulation of money, you expect lesser circulation of money. Third one is incorrect. Right? So right option is only the second will lead to increased money multiplier. Right option is option A, only one. Everybody is okay? Can we move on to the next concept now? Do let me know. Can we move on to the next concept? Right? So, right, the last concept associated with money multiplier 1 upon reserve ratio, is it correct, my dear? Yes. NCERT says money multiplier is equal to 1 upon reserve ratio. What is the basic idea there? 1 upon reserve ratio means, imagine you have a reserve ratio of 10%. That is 10% of the deposits that you have collected, you will have to keep it in the form of reserve ratio. What NCERT says is, money multiplier can be calculated this way. That is M3 upon M0. This is the most efficient way to measure money multiplier. There is one more way, M1 upon M0. But M1 doesn't consider the overall money supply. M1 is looking at only the narrow money. Right? But anyways, that is also given as one way to calculate money multiplier. Another way to calculate money multiplier is, right, whatever is the reserve ratio, 1 upon reserve ratio. That is, let's say reserve ratio is 10%. It means 1 upon 10% will become 1 upon 10 upon 100. Right? Denominator of the denominator becomes numerator. It will end up becoming 100 upon 10. Cancel. Money multiplier will be 10 times. And if you calculate the way that we have calculated, you will get the same number. Only way is difference in the methodology, but the outcome will remain same. Right? What is M4? My dear, take M3 and add post deposits. That's it. Take M3 as it is, add postal deposits. That will give you M4. No difference whatsoever, in the sense M2 you added postal deposit to M1, M4 you add postal deposit to M3. But that's not important in the context of RBI making a policy. Again, reason being, the M4 includes postal deposits. Postal deposits cannot be used to create loans. Right? The post offices do not create loans. So the money creation doesn't happen in postal deposits. So that's a reason M4 is calculated. But for the calculation, for the policy making, it is mainly M3 that is taken. Okay, right? Let's go forward. I think the last concept associated with RBI, the surplus transfer. What is the idea of a surplus transfer? Listen to me carefully. RBI is incurring expenditure. Okay, RBI incurs expenditure on one side. And RBI is also generating income. Simple. Okay. RBI spends money. So in what way? RBI spends money in, right, let's say providing, right, or paying interest to some of the banks. RBI will spend money on, right, salaries of the employees, etc. So on one side, there is expenditure. And on the other hand, RBI earns income by investing in government bonds, by buying and selling the government bonds, by buying and selling, right, gold, by providing loans and charging rate of interest on it. Right? So RBI generates income as well. So the amount of income generated is greater than expenditure. Normally for a company, this is called as a profit. Is it okay? If your income is greater than the expenditure, that is profit. But in the context of Reserve Bank of India, we do not use the term profit because it is not a commercial entity. Instead of profit, we use the term surplus. Instead of profit, we use the term surplus. Now, how much part of the surplus the government of India will receive from Reserve Bank of India? That is part of Section 47 under the RBI Act of 1934. All of you remember this? Section 47 under the RBI Act of 1934. It is about surplus transfer. So, what part of surplus will go to the government of India? There is a formula which has been recommended. You don't worry about the formula. It's slightly complicated. Simply remember the recommendation regarding the surplus transfer which is followed right now by RBI is given by Bimal Jalan panel. It is provided by Bimal Jalan panel or Bimal Jalan committee. Right, this particular committee was set up by the government of India. Based on this recommendation, today, whatever is the surplus generated by RBI, it will decide based on the formula given by the committee how much should be given to the government, how much should be left with RBI, how much of it should be kept itself with RBI. Right? Why should they give it to the government? Reason is simple. Government of India is the owner of Reserve Bank of India. Government of India is the owner of Reserve Bank of India. So any profits generated by a company should go to the owners of the company. So who is the owner here? Government of India. So Bimal Jalan panel was set up. recommendations have been provided, accepted. Even today, those recommendations are used to transfer surplus to the government of India. Right? So these are certain important points associated with Section 47 of Reserve Bank of India Act. Done? Right? So these are the important concepts, different right issues, even connection to the current affairs associated with Reserve Bank of India. Now let's go beyond RBI. Let's discuss in different aspects within the banking sector. Now, when the banks will provide loans to you, on what basis do they charge a rate of interest? On what basis do they charge a rate of interest? So, lending rate regime. Right? Listen to me carefully. Earlier, back in the year 1994, RBI introduced primary lending rate, PLR, primary lending rate. Right? This was introduced back in the year 1994. Then in the year 2003, RBI introduced benchmark primary lending rate. Right? This is a PLR. This became BPLR, benchmark primary lending rate. Then in the year 2010, RBI introduced base rate regime, BRR, base rate regime. In the year 2016, RBI introduced MCLR, marginal cost of funds based lending rate. And then in the year 2019, RBI is introduced external benchmarking. External benchmarking, right, based on the recommendation of Janak Raj Committee. Janak Raj Committee. Okay. Right now, what are the different rates or different systems used in India? Mainly we use the last two. Please remember them. Mainly we use the last two, that is marginal cost of funds based lending rate and external benchmarking. These two are used currently in deciding the lending rates. That is basically the rate of interest on the loans. But what is the difference? What is the difference? And if you have MCLR already, why did RBI introduce one more type of a lending rate? That is basically external benchmarking. Listen to me carefully. The earlier systems were referred to as internal benchmarks or internal benchmarking. What is the basic idea of internal benchmarking? RBI will give you parameters. You decide what is your lending rate according to your, right, let's say calculations. Within your bank, you find out what is this parameter, etc. You decide the lending rate. That is internal benchmarking. For example, under MCLR, right, what was the methodology that was followed? RBI simply said, a bank, whenever it will collect deposits, whenever it will collect money, either from a depositor, right, which could be an individual, either from a company if they collect a fixed deposit, or if they take loan from RBI under Repo, etc. So, is everybody able to understand? Whenever they take money, whenever they borrow money, bank will pay interest on it. Yes or no? Please participate. I know late night, 9:20, you people do not have the habit of sitting for the classes late night, but do participate. So banks will take money in different ways from depositors, customers, from RBI, etc., but will pay a rate of interest on it. So whenever this rate of interest would change, RBI said, you change the lending rate. Is everybody okay? Under MCLR, I'm saying, listen to me carefully. RBI simply said, you are collecting deposits. And on the deposits, on the loans, on the fixed deposits that you collect, you pay rate of interest. If this rate of interest changes even by a small number, then you change the rate of interest on the loans that you are providing. In addition to that rate of interest, include the profit that you want to earn, include operational expenditures that you are incurring, etc. So based on your internal parameters, you decide what is your lending rate. That was essentially the marginal cost of funds-based lending rate. On paper, I repeat, on paper, this looks very nice. RBI is telling a bank, you take, right, whatever internal numbers are there, you decide the lending rate. Which means you expect the bank to charge a rate of interest which is fair, which is transparent, which is representative of the cost that is incurred by the bank, etc. But what RBI found was, whenever the rate of interest that the bank pays increases, suddenly the banks will increase the rate of interest on the loans. But when, right, the rate of interest that the banks are paying will go down, the banks are very slow in transferring that in the form of reducing the interest rate on the loans that they have given. Is everybody able to understand the problem here? RBI said, you are collecting, let's say, deposits, you are taking loan from RBI, and the rate of interest that you pay on this, if it goes up, you are very fast in increasing the rate of interest on the loans that you have given. But if this will go down, you are very slow in, right, providing the benefit to the borrowers in reducing the interest rate. So RBI initially felt that the system will be very fair, system will be very transparent, system will be, right, assisting the borrowers in ensuring that the rate of interest are reflecting the real cost in the market, etc. But RBI realized banks are not playing fair game. That's a reason in 2019, based on the recommendation of Janak Raj Committee, RBI has introduced a new system, that is external benchmarking. External benchmarking. In external benchmarking, what is done? RBI simply tells the bank, don't take internal parameters, link the rate of interest that you charge on a loan to an external parameter. Not internal parameter, external parameter. Meaning what? You decide your rate of interest on the loan by connecting that rate of interest to repo rate. Connect that lending rate, connect that rate of interest on the loan to the repo rate. For example, let's say the rate of interest on one of the loans that the bank is providing is like this. Repo rate plus, let's say hypothetically 4%. Hypothetical, okay, 4%. Which means, imagine if the repo rate is 5%, then the rate of interest on this particular loan automatically will become how much? Right? 9%. Everybody is okay? Automatically will become how much? 9%. Now, if RBI reduces the repo rate from 5% to 4.5%, if RBI reduces the rate of interest from 5% to 4.5%, automatically the rate of interest on the loan will get adjusted to 8.5%. And some of you will be thinking, sir, what is the guarantee that the banks will adjust this? The RBI policy now says once every 3 months. Once every 3 months, the bank has to take the existing repo rate and adjust its lending rate. Very simple. RBI simply says once every 3 months, the bank has to take the existing repo rate and adjust its lending rate. Right? So if the RBI has reduced its repo rate, automatically the rate of interest on the loans will go down. If RBI has increased its lending rate, automatically the rate of interest on the loans will increase. Automatic adjustment of the loans will happen with the change in the repo rate. That is basically the concept of external benchmarking. Lot of the loans, for example, loans which are given for housing, loans which are given for MSME, a lot of these particular loans have been brought under the concept of external benchmarking by RBI now. Is everybody okay? Please do let me know. Everybody is okay with the concept of the lending rate regimes, right? Evolution I've told you. Right now, mainly what type of regimes we are using? MCLR as well as, right, the idea of a external benchmarking. Lot of the loans are covered under the external benchmarking. And those who are wondering, sir, why not shift to completely external? Objective is there, but immediately cannot be done. Over a period of time, we will move towards complete external benchmarking. Okay. Now look at the MCQ here. Consider the following statements regarding external benchmarking regime. It will ensure the lending rates are fair to the lenders as well as borrowers. Of course, yes. If the repo rate goes up, right, rate of interest will go up. If the repo rate goes down, rate of interest will go down. Now listen to me very carefully. Although I'm explaining external benchmarking using repo rate, is it compulsory? I repeat, is it compulsory that it should be always connected to the repo rate? No. RBI simply tells the banks you have options. One is you can connect to the repo rate, which most of the banks have done. In addition to the repo rate, if you want to connect it to the yield rate of 91-day bonds, you can do that. If you want to connect it to, right, let's say yield rate of 182 days bonds, you can do that. Or you want to use any benchmark which has been calculated and published by FBIL, Financial Benchmarks of India Limited, you can do that as well. But most of the banks have chosen repo rate. It will ensure lending rates are fair to the lenders and borrowers. Yes. Under this, the banks must change the lending rates once every month. No, right? It's not once every month, once every 3 months. Has been recommended by the Janak Raj committee? Yes. The first statement, third statement are correct. Right option for the question will be option B. Only 2 of the statements are correct. Next. What is FBIL? My dear, there's a financial institution. Don't worry about all of it. There is a financial institution by the name of FBIL, Financial Benchmarks of India Limited. So this FBIL comes out with multiple indices. You can take one of the index, connect it to that particular number. That is the recommendation of RBI. Okay. Why every 3 months? So that once every quarter, right, there can be adjustment that can be done. Earlier, there was no time period that was mentioned by RBI and the banks delayed it. Some of the banks used to adjust their lending rate after 6 months, after 8 months, etc. Now RBI says every quarter you will have to do it. Okay. Now, next, CBDC, Central Bank Digital Currency. Somebody was asking before the dinner break, and most of the students after the dinner break have vanished. Anyways, those who are present, listen to me. Right? CBDC, Central Bank Digital Currency. What is this idea of a central bank digital currency? Right now, the practice in case of India has been that the currencies are usually issued in the physical form. And what is the idea of a physical form? Basically, the currency notes are printed, the currency coins are minted. But let's focus on the currency notes because most of the money that is supplied, it is in the form of currency notes. Currency coins form a fraction of total money supply. But the problem here is every now and then there is a concern of counterfeit of the currency notes. Correct? All of you have heard of this counterfeit, fuzzy notes. Every now and then RBI has to withdraw the existing currency notes and print and distribute new currency notes. In addition to that, there is also a problem associated with soiled currency notes. That is, the currency notes will become unusable. Right? You must have seen certain currency notes where 20 places a cello tape is pasted. You will see certain currency notes, right? You will see that, right? For example, let's say this is a currency note, right? One of the UPSC candidate will get this particular currency note. In the examination hall, complete blank sheet is given to the candidate to write an essay. They will not write there. But they will see there's a blank space on one part of the currency note. They'll see there is a blank space. They'll start writing essay in that particular blank space. Right? Or somebody will simply say, right, let's see, I am a great follower of Paulo Coelho. Right? Whether, right, fate has something in my favor, let me put a sign on the currency note and circulate. and let's see whether it will get circulated throughout the whole India and come back to me. My dear, all of these are essentially soiled currency notes. Soiled currency notes. These are unfit to be circulated any further. So RBI simply says there are so many issues in terms of printing as well as a distribution of these currency notes. And all of that requires resources. All of this requires expenditure to be incurred by Reserve Bank of India. So what has RBI done? It has proposed an alternative to physical currencies, that is digital currency. Digital currency, right? This particular digital currency is nothing but CBDC, central bank digital currencies. And by the way, India is not the only country which is trying out with the CBDC, by the way. There are multiple other countries. For example, Nigeria is trying this out. Bahamas is trying this out. China is also trying out the concept of e-pilot in the CBDC. What is the logic here? Logic is simple. Instead of printing and issuing the currency notes, now the digital form, simple, the digital version of the currency notes will be issued. For example, you will be asked to open a wallet, right, that is connected to a particular bank where you have having the bank account. And in that particular wallet, instead of having physical currency notes, the digital currency notes will be transferred into your wallet. So RBI simply says these currencies which are digital in nature will essentially reduce the cost of printing for me. And because these are digital currencies, easily these can be transferred. And the RBI also says these CBDCs, central bank digital currencies, can be programmed. Please remember this. These can be programmed. Programmed for what purpose? These can be programmed in certain way that these currencies can be used for specific purposes. The currencies can be used for specific purposes. Sir, what is the meaning of it? Let me give an example. Let's say the government of India wants to transfer 100 rupees into a bank account, but they want this 100 rupee to be used only for purchasing of food grains. Hypothetically, okay? The government of India wants to give you money, but they want you to use it only for purchasing food grains. In that case, they can use the central bank digital currency, program it in such a way that this will be accepted only in the shops where you will be allowed to use the money to purchase food grain. If you take that particular digital currency, go to Inox, will they be able to accept it? No, they will not be able to accept it. Right? This can be programmed in such a way. So programmed in specific consumption purposes, programmed to be used within specific time period, etc. So these kind of currencies can be programmed, and that's the reason RBI has been pushing the idea of a CBDCs in India. CBDC for retail usages have been released. CBDC for wholesale usages or wholesale market transactions also have been promoted by Reserve Bank of India. Done? And idea is simple. Right? Don't complicate this. Instead of having physical currency note, it will be converted into digital form and it will sit in your wallet. That's it. Sir, can I submit it and get, right, let's say currency notes from a bank? Of course, yes. These can be these can be submitted to the bank and the bank will give you physical currency notes. Right? That is can be converted into fiat currency, physical fiat currency. Right? All these are essentially, right, the concept of a CBDC. Can we go forward now? Please do let me know. CBDC is a legal tender in transactions. Yes, it is fiat money. It is fiat money. It is a digital version of fiat money. That's it. All of you able to understand? It's a digital version of fiat money. Instead of having physical copy, you will have a digital copy. And I know some of you will be thinking, sir, then why am I not using it? Right? I know most of you do not use the CBDC. I know that. Even RBI knows that. And the answer to that is very simple. You and me, we have gotten accustomed to the idea of a UPI. Very simple. You and me, we have become so much accustomed to the idea of a UPI, We do not want to shift away from the concept of UPI. Because we are using UPI, we feel there is absolutely no incentive for me to shift to using CBDC. And somebody was asking, sir, where can I get the CBDC? My dear, any bank where you have got the bank account, please check your messages. The bank would have already sent a message to you. The bank would have already sent a message to you saying that CBDC is there, download the app, etc. etc. So argument is simple. CBDC is there. It is being used also. But only thing is that the retail, that is the individual customers, are very hesitant to shift to the idea of CBDC because we have become accustomed to the idea of a UPI right now. Is it okay? Done? Can we reduce the counterfeit notes with CBDC? Of course, yes. Imagine, just imagine. There are no physical currency notes. Just imagine, cashless economy. There are no physical currency notes whatsoever. Everything is CBDC. So don't you think the issue of counterfeit currency is there itself will be addressed? Right? Okay. Now that is also there in the discussion. Let's go forward. Liquidity with CBDC. My dear, what is the issue with liquidity? Do let me know. It is same as the concept of fiat currency only. Again, I'm saying it is the same as the concept of fiat currency. Right? Can you convert this into physical currency notes? Of course, yes. Of course, yes. It's same. Only thing is it is in the digital form. That's it. Okay. Right? Let's go forward. Payment and settlement systems. Different types of payment and settlement systems. Now, in case of India, please remember, associated with the payment and settlement system, there is an act, Payment and Settlement Systems Act of 2007. Payment and Settlement Systems Act of 2007. Under this particular act, there are different forms of payment and settlement systems. There is, right, paper-based payment and settlement system. There is also digital payment and settlement systems. And those who are wondering, sir, what is this payment and settlement system? How the funds can be transferred. Simple. Right? Those who are wondering, sir, what do you mean by payment and settlement system? How the funds can be transferred in the form of paper-based instrument. Example, checks. All of you heard of checks? Right? Can I write a check, give it to you, and the funds can be transferred? Yes. Right? What about digital fund transfer methodologies? RTGS. How many of you heard of this? Favorite area of UPSC, by the way. RTGS, NEFT, right? IMPS. All these are favorite areas of UPSC. So there is a basic system where paper-based instruments are used for the fund transfer. There are also digital methods, digital instruments used for the fund transfer. Now let me give you a basic idea, a comparison between all the three. Again, I'm saying this is one of the favorite areas of UPSC. Favorite areas of UPSC. And before somebody says, sir, your head is covering part of the, right, let's say the third column, let me minimize it. Right, you have NEFT, we have RTGS, we have IMPS. Right? What is NEFT? National Electronic Fund Transfer. RTGS, Real-Time Gross Settlement. And IMPS stands for Immediate Payment Services. Under NEFT, right, and under all the three, you can transfer funds at any point of time. Right? All the three have been made 24/7 now. 24/7. But the essential difference is that under NEFT, whenever the funds are transferred, the transfer of the funds is slightly slower. The transfer of the funds is slightly slower. That is, the funds are transferred or the transactions are cleared in a batch of half an hour. Is everybody able to understand? In a batch of half an hour. So, in the half an hour, whatever NEFT transfer requests have been put together, all of them will be created or pulled into one batches, and in 30 minutes, all these transactions will be cleared in one shot. That is basically NEFT. In batches, they are cleared. That's the reason it will take time whenever you transfer under NEFT. And that is also the reason why the charges associated with NEFT are very negligible. But RTGS, real-time gross settlement. RTGS, which is also available throughout the day now, 365 days. Under RTGS, the fund transfers can be done immediately. Immediately. That's the reason they use the term real time. Right? Immediately the fund transfer will happen. But please remember this. Under RTGS, there is a minimum limit. Right? There is a limit. Above this only the transfers are allowed, not below this. Whereas in NEFT, you can transfer even 1 rupee. IMPS, you can transfer 1 rupee. But RTGS, if you want to transfer, you will have to transfer a minimum of 2 lakh rupees. Everybody is able to understand these particular points. Minimum amount has to be 2 lakh rupees under RTGS, nothing less than 2 lakh rupees. Right? Now, maximum, no limit, maximum, no limit for NEFT and RTGS. Right? Whereas in case of IMPS, per day, the limit under IMPS is 5 lakh rupees. Right? Availability, all the 3 of them are available throughout the day. Managed by, the first 2 are managed by RBI, that is RTGS and NEFT. And the third one, IMPS, is managed by NPCI. Is everybody okay with the discussion? Comparison between all the 3? Please do let me know. Is everybody okay with the comparison between all the 3? Please download the PPT, right? And use the PPT for revision. What is the rationale for such limits? What limits, my dear? You think you are talking about IMPS? There are different types of limits. Even in case of NEFT also, different banks can impose a different limit. The argument of imposing the limits is there is always a scope of, let's say, misuse of certain access to funds. There is always a scope. For example, I don't know how many of you have observed it. Whenever you have, right, let's say, started UPI, right? Imagine you have downloaded the app, either Google Pay, Phone Pay, whatever it is. You have registered on the app. For the first 24 hours, UPI will not allow you to transfer beyond certain limit. Why? There is always a scope of misuse. There is always a scope of abusing the system. What if multiple UPIs are created simultaneously, no limit? A lot of the black money will be circulated from one part of India to another part of India. So generally, there are certain limits which are imposed by different, right, service providers because of these particular concerns. Okay. Can we move on to the next one now? Please do let me know. Can we move on to the next one? In the context of the check-based payment system, very recently, there was a discussion also. Until now, the check-based payment system used to take some amount of time. Now, RBI simply says the check-based payment system has to be cleared within hours. Right? A check-based payment system has to be cleared, right? Through this has to be cleared within hours as well. Okay, done? Okay, right, let's go forward now. Please solve the MCQ. Consider the following statements. There is no minimum limit on NEFT and RTGS. NEFT, IMPS are managed by RBI. Arre Baba, just now we have discussed IMPS, no? Gaurav Jaiswal, my dear, just now we have discussed IMPS, immediate payment system. It is a type of a, right, let's say, instrument that is used to transfer funds. It is used. It's a system used for transfer of the funds. Hardly been 2 minutes, my dear. Okay. Third one, any NEFT, RTGS and IMPS are covered under the Payment and Settlement Systems Act of 2007. Third statement is true. Any NEFT and IMPS are managed by RBI? No, this is incorrect. RTGS and NEFT, RBI, IMPS by NPCI. Okay. There is no minimum limit on NEFT and RTGS. Minimum limit, right? Maximum, there is no limit, right? For minimum, NEFT has to be 1 rupee and RTGS has to be at least 2 lakh rupees. At least 2 lakh rupees, right? So this particular statement is incorrect. 1 and 2 are incorrect. Third one is correct. Right option is option A. A lot of you have said option B. Why? A lot of you have given option B. Why? What is the issue? What is the issue? Please do let me know. Any confusion? Any confusion? Okay. Can we go on now? Can we move on to the next concept? Please do let me know. Can we move on to the next concept? Word minimum was skipped. Okay. Right. Please read the questions carefully. Don't make a mistake. Please read the questions carefully in the examination. Okay. Let's go forward. Cooperative banks. The concept of cooperative banks. Okay. Right. So cooperative banks, listen to me carefully now. Cooperative banks essentially are divided into two parts. One is, right, the urban cooperative banks, and the second one is rural cooperative banks. Urban and rural. Urban, these particular cooperative banks can be scheduled cooperative banks as well as non-scheduled. Scheduled as well as non-scheduled. The urban cooperative banks can also be present in one state or multiple state. They can be present in one state or multiple state. Okay, so these are certain points in the context of urban cooperative banks. And right, if you're thinking, sir, any special feature of urban cooperative bank? As such, nothing. These are cooperative banks. Agreed. What's a cooperative? Cooperative essentially is a group of at least 10 adults. Adults means above the age of 18 years. Cooperative, the legal definition is when 10 people, right, 10 or more than 10 above the age of 18 years come together to achieve a common objective. That is called as cooperative. The cooperative can be formed in housing. Cooperative can be formed in, right, let's say sugar. Cooperatives in milk. Cooperatives in textile. Cooperatives in banking. Right, so cooperative banks essentially, right, can be present in urban parts of India, hence called as urban cooperative banks, and they can also be present in rural parts of India. Right, these are called as rural cooperative banks. In case of rural, there is a further division. There is a further division like this. That is essentially the rural, right? There are two verticals like this. One, there is a state cooperative bank. There is a state cooperative bank. Below state cooperative bank, there is a district cooperative bank. District cooperative bank. And below the district cooperative bank, there is a primary agriculture credit society. PACS, Primary Agriculture Credit Society. And the second vertical is essentially, right, which is involved in providing long-term loans, medium-term and long-term loans. At the helm, at the top, we have state cooperative and agriculture rural development banks. State cooperative agriculture rural development banks. S card B. And below S card B, we have primary cooperative agriculture rural development banks. Right? S card B and below that P card B. This is essentially the structure of cooperatives in India. So urban, rural. Within rural, we have, right, those particular structures which are more focused on short-term loans, and we have a structure which is more focused on the medium as well as long-term loans. Is the structure of cooperatives okay with all of you? Please do let me know. Is the structure of cooperative okay with all of you? I know, right, for a lot of you, a lot of things are new, but these things are important, by the way. These things are very, very important. Now, in the context of cooperative, what are the other important points? Historically speaking, the regulation regarding cooperatives has been divided between the Reserve Bank of India as well as the government. Because whenever you talk about cooperatives, these cooperatives are registered with either the state government, if it is a single state cooperative, or is registered with the central government if it is a multi-state cooperative. So when you talk about the regulation, right, let's say the overseeing of the functions of the cooperative, the powers have been divided between both the government as well as the RBI. Because this cooperative is involved in collection of deposits, giving loans, etc. RBI will be regulating that. And cooperatives, elections have to be conducted. There is management in the cooperatives. Administration of the cooperatives have to be done. that comes under the State Registrar of Central Government or Central Government Registrar. So there is always historically a dual regulation associated with cooperatives. But the problem is that the cooperatives, because there is an element of elections, the management may not understand what is the function of a bank or how to utilize the funds, how to protect the interest of the customers, how to generate profits, etc. Because I hope you understand, the management of the cooperative is elected. I hope you understand. Management of the cooperative is elected. The board of directors is elected. The chairperson is elected. So what if the person or the management doesn't know how the bank operates? Right? So in that particular case, there is always a risk. And that's the reason a lot of times in case of cooperative banks, you must have seen, not recently, but many years ago, lot of these particular cooperative banks started incurring losses. There was issue of mismanagement, etc. For example, one of the largest cooperative banks, urban cooperative banks by the way, Punjab Maharashtra Cooperative Bank, PMC, Punjab Maharashtra Cooperative Bank, ended up giving most of their loans, more than 70% of their loans, to only one company. Think of it. More than 70% of their loans is given to only one borrower. What if the borrower doesn't repay? And that's exactly what happened. So there has been a concern or the issue associated with regulation of cooperatives. And that's a reason the Government of India made an amendment to the Banking Regulation Act. The Government of India made an amendment to the Banking Regulation Act. Right? The amendment was passed back in the year 2020, and with the passage of this particular amendment, more and more powers now have been given to Reserve Bank of India. More and more regulatory powers associated with the cooperative banks, especially urban cooperative banks, have been given to Reserve Bank of India. For example, Reserve Bank of India, in addition to the board of directors, there will also be a board of management. The board of management will have experts. And who are the members of board of management? The cooperative bank is allowed to appoint them. But if RBI will object to some of the appointments, then they will have to be changed. The board of management will basically advise the board of directors regarding banking operations. If RBI feels a particular urban cooperative bank is not operating in the interest of the customers, then with the consent of the union government, it can basically force the merger of this particular cooperative bank with another cooperative bank. The board of directors can be suspended. The operations, powers of the operations can be taken to the Reserve Bank of India. RBI can appoint an administrator to oversee the functions of the urban cooperative bank. So these kind of the powers have been given. These kind of powers have been given to Reserve Bank of India under the Banking Regulation Amendment Act of 2020. Please remember that. Done. And earlier also, right, back in the year 1966, the Banking Regulation Amendment Act was introduced by the government. The cooperatives were brought under the purview or the regulation of Reserve Bank of India. Right. So these are certain important points associated with the cooperative banks. Everybody is okay? Please do let me know. Somebody was asking, sir, give me the full form of SCARD-B. SCARD-B stands for State Cooperative Agriculture and Rural Development Bank. PCARD-B stands for Primary Cooperative Agriculture and Rural Development Bank. Regarding the full forms, please don't panic right now. Please download the handouts later. I'll upload the handout in my Telegram channel. Complete banking chapter. Download it. Complete banking chapter. Right? And use it for revision. I know you people are more interested in downloading. Forget about reading. Right? Because I know most of you will simply say, today, very tired, sir. Full evening, I've been hearing only banking. So I'll take it up tomorrow. Tomorrow, you'll simply say, right, Wednesday, mid of the week. Right, so I'm not interested. Right, just give me some time. I will revise it. Maybe after 2 or 3 days. After 2 or 3 days, it will essentially lead to weekend. You'll simply say, weekend. I require rest. I cannot keep on putting so much of stress on my head, etc., etc. Then 25th December will come. You will be in a different mood celebration altogether. Then the 31st December will come. You will simply say, "Array, party. We should party. This is the time for party." You will simply say. Suddenly you will realize the calendar is old now. New calendar has come, 2026. Now you'll simply say, no, 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 I need to focus on optional. I need to focus on C-site. I need to focus on other subjects. How much will I read? Only banking. Okay, right? So please don't focus only on the downloading of the notes. My recommendation is please focus on revision as well. Okay, now next, payment banks. Other concepts associated with, right, the banking sector, payment banks. Now, please do let me know if there are any doubts before I go forward. I just want to ask you people, are there any doubts? Please tell me. Are there any doubts? Sir, please provide some mains practice questions as well. Dharani, my dear, from banking chapter. I don't know how many of you have seen the trend of UPSC. From the banking chapter, 0 questions have been asked in the mains in the last 5 years. 0. A grand 0 from banking in the mains in the last 5 years. That's a reason. Okay. Your Telegram channel. My dear, the Telegram channel, Economy for Exams by Shyam Shankar Kaggod. Right, if you search, you will get it. Economy for Exams by Shyam Shankar Kaggod. Okay, and Shyam Shankar Kaggod is me, by the way. Shyam Shankar Kaggod is me, by the way. Some of you will simply keep on wondering, who is this Shyam? I am Shyam, by the way. Okay. Sir, the part of the reserve kept by banks from deposits is included in the FRS, or is it only part of the banks used for lending? My dear, fractional reserve system simply means part of the deposits bank will keep and remaining part they will lend. This system is called as FRS. The system is called as FRS. Okay. Okay, done. Right. Payment banks. Right. Couple of more concepts are there. Then we can close the session. Don't worry. Okay. Done. Payment banks. Right. Please understand. There is this concept of differentiated banks. Okay. Differentiated banks. What is the basic idea for differentiated bank? On one side, we have universal banks. For example, SBI. It's a universal bank. Right? Universal bank means what? It will provide you the primary banking services as well as secondary banking services. It will allow you to open a bank account. It will allow you to take a loan. It will provide you gold loans. It will give you locker facility. It will provide you the facility to transfer funds, etc. So primary as well as secondary functions, both of them are associated with the universal bank. But there are also differentiated banks which have been promoted by Reserve Bank of India post 2014 and 2015. What is the idea of a differentiated bank? These kind of banks will not offer all the services to you. Not all the services. Only few of the services will be provided. Not all the services, only few of the services will be provided. And who is going to decide what kind of service? Reserve Bank of India. RBI will decide what kind of service will be provided by this kind of a differentiated bank. Now from 2015, RBI has been promoting 2 types of differentiated banks. One is the payment bank and the second one is small finance bank, SFB. One is the payment bank and the second one is a small finance bank. What is basically the idea of a payment bank as well as a small finance bank? Both of them have been announced or have been implemented as a model of banking in order to promote financial inclusion. In order to promote financial inclusion. What's a basic idea for financial inclusion? Whenever you provide financial services to the needy people at their doorstep in a cost-effective manner, that is called as financial inclusion. Is it okay? I'll repeat it again. Whenever you provide financial services to the needy people at their doorstep in a cost-effective manner. That is called as financial inclusion. I'll give you the best example. Pradhan Mantri Janadhan Yojana. Pradhan Mantri Janadhan Yojana. It's a best example for the promotion of financial inclusion. Now, the payment banks as well as the small finance banks, like I said, are differentiated banks. Both are different, or both are having a different model. The Reserve Bank of India has promoted both of them. And some of you might be thinking, sir, if there are already scheduled commercial banks, universal banks are there, why not allow these particular banks to directly operate as universal banks? What is the logic of, right, allowing a payment bank, allowing, right, let's say a universal bank, allowing a small finance bank, etc.? Now listen to me very carefully. RBI right now follows a concept called as on-tap licensing system. Right now, RBI follows something called as on-tap licensing. What is this idea for on-tap licensing? Unlike earlier situation, RBI doesn't basically say you'll have to submit the license only in this month, or the window for submitting for the license for a bank is open now, etc. No. RBI simply says at any point of time you want a banking license, you apply. You apply. But just because you have applied doesn't mean you will get a banking license. Right? Is the logic okay? You can apply at any point of time. But RBI doesn't guarantee that you will be given a license. RBI will take its own sweet time to decide whether a license should be issued to you or not. For example, very recently, Fino, right? Fino is a payment bank in India. Very recently, the Fino Payment Bank has been given the license by Reserve Bank of India to become a small finance bank. It has been given a license to become a small finance bank. And just take a wild guess. Before how much time Fino submitted the application? Right? Just take a wild guess. What was the duration? Before what time period? Right? According to you, right? Before how many months, days, weeks, or years has the Fino submitted the application to get a SFB license? They had submitted 2 years ago. They have submitted the application to convert from the payment bank to a small finance bank 2 years ago. RBI took 2 years to give an approval for Fino to become a small finance bank. And the logic of RBI is very simple. First, you will be asked to operate as a payment bank. Operate for 5 years. Prove to me that you can manage the finances. Prove to me that you can remain profitable. You can, right, take care of the operations, etc. Then I will allow you to become a small finance bank. Now you operate as a small finance bank for minimum 5 years. And then again apply for a license. I will consider whether to give you a license to convert as a universal bank or not. Is everybody able to understand the logic here? Please do let me know. Right? So logic of RBI is, right, no, I will not allow you to directly become a universal bank. It's like tomorrow when you become an IAS officer, on the first day itself, you will be appointed as cabinet secretary. I know all of you will be happy. Just thinking of that, just the thought of that has already made you happy. Right? You're thinking the ambassador car coming to your home, stopping in front of your home, 2 people running and opening the door for you, right? You walking like Rajnikant or let's say Hrithik Roshan and entering into that particular car, etc. I know that is very fascinating. But do you know what is the role of a cabinet secretary? You know that cabinet secretary is basically the highest position within the IAS officer, the highest salary, etc. But what is the actual role? How to manage the day-to-day operations as a cabinet secretary? You have no idea, you have no clue whatsoever. That's the reason you need, right, let's say, experience. RBI also says the same thing to the banks. First get experience. Work as a payment bank. Sustain. Then work as a SFB. Show to me that you can sustain. Then I will consider whether you are eligible, whether should you be given a license to work as a universal bank. That is how the evolution has to happen. So payment banks, essentially, right, the idea of a payment bank has been promoted since 2015 by RBI. In fact, RBI had issued 11 licenses. 11 licenses for payment banks. Most of them either they have returned the license, they have submitted the license back to RBI. Some of them started operating, then closed down, right? Shut down the operations of payment bank. Because the model of payment bank is that you are allowed to collect deposits, but per customer, you are not allowed to collect more than 2 lakh rupees. Per customer, you can't collect more than 2 lakh rupees. And when you collect 2 lakh rupees, can you provide loans to borrowers? No, that is also not allowed. You're not allowed to give loans, right? You will have to use 75% of your deposits in government securities. 75% in government securities. Remaining 25%, you will have to deposit with another bank. You will have to keep these particular deposits with another bank. Interbank deposit. Earlier, that is in the evening, I was talking about this. So 75%, right, in the government securities, 25% in the deposits. But remember this, anybody who has, right, basically kept the deposit with you, you'll have to provide insurance premium to them. That is, you'll have to pay insurance premium to DICGC. Insurance services have to be provided, right? So argument is payment bank model is not easy. There are a lot of restrictions associated with the payment bank. And that is the precise reason why a lot of the entities which were initially given the license, they have returned the license back to Reserve Bank of India. Done? Everybody is okay with the model of a payment bank. Now there is one more type of a differentiated bank, small finance banks. Small finance banks, SFB, small finance bank. What is the model of a small finance bank? Right, the small finance banks essentially, right, are a type of a differentiated banks which will focus on providing loans or credit to certain borrowers who are underserved as well as unserved. Who are underserved as well as unserved. That is, for example, MSME, micro and small enterprises, small and marginal farmers. So RBI simply says there are certain types of borrowers. These kind of borrowers find it very difficult generally to get access to institutional credit. So this kind of a, right, let's say the banking model has been promoted by RBI. Under SFB, right, essentially RBI mandates that those entities which are operating as SFB, they will have to have very high criteria of PSL, priority sector lending. They will have to have very high criteria. They will have to meet a higher PSL. To begin with, when initially it was launched, under the small finance banks, the PSL target was 75%. Right? Initially, the target was 75%. Very recently, RBI has reduced this particular target from 75% to 60%. Wherein the basic idea is there are certain types of borrowers. For example, small and marginal farmers. Right? There are type of borrowers, micro and small industries. So these kind of borrowers will have to be identified, and right, most of these particular loans from the SFB has to go to these kind of borrowers itself. That is a basic model of a small finance bank. But the idea is very simple. They are allowed to collect deposits. No limits, no restriction. For example, in payment banks, there is a restriction 2 lakh rupees per customer. In SFB, no restriction whatsoever. You can collect like a normal bank. But when you lend, there are restrictions. There are restrictions associated with this. And how many branches you are opening, there are restrictions over that as well. Because RBI simply says 25% of the branches you will have to open in rural areas. 25%, a fourth of the branches. Right? In addition to this, the small finance bank will have to maintain CRR, SLR, just like a normal bank. Right? There is also application of capital adequacy ratio, CAR. Right? What is a capital adequacy ratio? Please remember this. Under Basel guidelines, the Basel guidelines mandates that every bank will have to maintain certain amount of its own money. Capital is nothing but own money. The bank has to maintain its own money in order to absorb the losses. So how much should be the capital that should be maintained by these particular differentiated banks? The RBI has mandated 15%. RBI has mandated 15% capital requirement. Okay, 15%. So these are certain important conditions which are applicable to the small finance bank as well as payment banks. Is everybody okay? Please do let me know. Let's solve the question here. Please solve the question and tell me what is the right answer. Solve the question and tell me what is the right answer. Consider the following statements regarding small finance banks. These will have to maintain a capital adequacy ratio or capital to risk weighted assets ratio of 9%. The PSL requirement for the SFBs is 75%. The depositors in these banks will have deposit insurance of up to 5 lakh rupees. How many of the statements are true? Some of you are saying option D. Some of you are saying option A. Okay, let's start. These will have to maintain a capital adequacy ratio of 9%. No, they will have to maintain 15%. Even the payment banks will have to maintain a capital adequacy ratio of 15. The PSL requirement for the SFBs is 75. No, until now it was 75. Now it is 60%. Second one is incorrect. Third one, the depositors in these banks will have deposit insurance of 5 lakh rupees. Yes, that is applicable for any bank, by the way. Right? For example, if you have a deposit in the, let's say, universal banks, you will get the deposit insurance of up to 5 lakh rupees. Right? So, third statement is correct. Right option for the question is option A. Only one is correct. Done? Everybody is okay? How many of you are tired? How many of you basically say, sir, done? Right? Let's stop the discussion here. Please do let me know. Those who are present in the session. Everything is going on well? You are able to understand whatever I am discussing? Manjit Singh says done. Okay. What about others? Sir, can you please explain option 3? My dear, there is a concept of deposit insurance. What is this idea for deposit insurance? There is an entity under RBI. Right? There is an entity under RBI. That is basically there is a subsidiary of RBI, DICGC, Deposit Insurance Credit Guarantee Corporation. Deposit Insurance Credit Guarantee Corporation, DICGC. Right? This particular DICGC offers insurance for the depositors. What is the basic idea? Any amount that is deposited, based on the amount that is deposited, for every 100 rupees, the bank will have to pay an insurance premium of 12 paise. Right? The bank will have to pay an insurance premium of 12 paise. That is essentially for 100 rupees, 12 paise insurance has to be paid by the banks. Now, because they will pay the insurance premium, the DICGC offers, right, insurance coverage. DICGC offers insurance coverage. Right? Up to how much? DICGC offers an insurance coverage of up to 5 lakh rupees. Up to 5 lakh rupees. Right? So, if you keep deposits, that's a reason. Right? A lot of times you will hear this. The experts will tell you, spread your deposits in multiple banks. Spread your deposits in multiple banks. Don't keep all your deposits in only one bank. Spread your deposits in multiple banks. So that if one banks fail, right, you can have, right, an insurance up to 5 lakh from this particular bank. And because you have not kept all your money in only one bank, you're safe, right? You are diversified your savings portfolio. Done? Everybody's okay? And in the current affairs, right, last point, let's stop today here. I'll take one more session to cover different concepts associated with banking, right? Don't worry. So, in the context of DICGC, there is one more important aspect in the current affairs. That is, very recently, Reserve Bank of India has proposed differential premium payment. How many of you heard of this? differential premium payment. That is, right now there is a concern. What is a concern? The universal banks, that is for example public sector banks, they will also provide the same premium, insurance premium, 12 paise for every 100 rupees. Cooperative banks also are contributing the same 12 paise for every 100 rupees. But if you evaluate in the last 4 to 5 years, how many banks have taken the insurance coverage actually? That is, how many banks have availed the insurance amount? Most of the insurance amount has gone to cooperative banks. Is my statement clear to all of you? Most of the insurance amount has been paid to the cooperative banks. So now the concern is, how can you collect the same amount of insurance premium for everybody, but the benefit of insurance is being availed by one group of banks? So that's the reason the Reserve Bank of India now has come out with the concept of a differential insurance premium. The ones with a higher amount of risk will pay higher premium, maximum 12 paise, higher premium up to 12, and those with lesser amount of risk will be asked to pay lesser amount of premium. Right? So this very recently has been announced by Reserve Bank of India. Everybody is okay? Right? Please do let me know if there are any doubts, confusions, etc. related to whatever I've discussed. So after that, right, we can close the session. Explorer, who will feel lazy in your class, sir? It's a pleasure. Thanks a lot. Tarak, sir, please tell about your past work experiences, bank and which bank? Right, don't worry about that. Right, don't worry about that. Any other questions? Sir, when is your economy batch on Unacademy? I think my plus batch is going to start in the month of January, 10th or 11th January. Any doubts? Any other confusion? Any other questions? No doubts? Okay then, right? So let me stop the discussion here. Do not worry about the notes. I'll give you notes. I'll upload the notes in my, let's say Telegram channel, download it. But this is my suggestion. Please do not keep on, please don't keep on simply downloading. Please read these particular notes. Okay. So that's it from my side. Take care. See you next time. Okay. Have a great day.